Namaste, good morning. So, friends, we are going to revise income tax. Of course, in this 15 Sundays, there will be some accounting and indirect tax classes. Each subject approximately 5 to 6 days, which means I'm aiming at 25 to 30 hours where we will revise fully. The intention is very simple, to take you to the examination. This is a direct examination, so that also the intention is that I'm not looking at you coming very highly prepared and all. Let us learn the concept in detail. Let us learn the concept in detail, so that any question comes in the examination, we'll be able to answer. In this process, we'll also learn some of the small nuances that the examiner expect you to understand. I tried to answer the May 26 paper, okay, and the RTPs, MTPs, MCQs that are released by the CA Institute. The question majorly revolves around that. If you want me to make you clear about some concept, if you want me to include some question in the material, please feel free to text me, so that in the subsequent classes I will include that and answer it too. Okay, but the intention is to ensure what type of exam question comes, how to prepare for exams, only exam related classes, to give you that confidence. Okay, one thing I'm very clear about is, whatever is your so far preparation material for classroom or for your understanding, you can keep it little away. This revision material is more than sufficient to take you to the examination. Yes, you can refer the existing material, but ensuring that this revision material is sufficient for you, it is being prepared. What is the common comment that I receive from students? Whatever may be the paper, that is, it might be very easy paper, little difficult. One common comment I receive from students is lack of time to answer. We are unable to complete the whole question. There are two reasons for that. Main two reasons. One, I accept the question paper are sometimes lengthy. I will take up that. Second is, our writing speed is slowly reducing. This I find especially with direct entry students. In your school, your writing speed is very good because every time you write. In your college, it has reduced a lot. It will not have the same writing speed. We should practice writing speed. We should practice together. Our mind and our hand should together work. That is the only solution. Lengthy paper is not in our hands. But what is there in our hands is, we should develop the speed of writing without compromising on the presentation, or without compromise. How to develop it? By practicing only. What we did in school is only right. We kept on writing every period, every hour. We kept on writing a lot, so that our speed was, we never had this comment in school. None of the school students will have this comment. But in all the professional courses, I always used to find this comment, that the paper lengthy I accept. Sometimes paper goes for 16 pages. To read that in 15 minutes, comprehend. But another reason which my experience tells me is the writing speed, which also I am trying to improve in the revision sessions. Please write. Please work out. Okay, don't just tick the answer. We are not auditing. We should work out and see. These are fundamental disciplines. and I follow one particular discipline in my revision sessions, that I don't question on what happened in the past, etc. and all. I will try to reduce the number of questions here to you, so that you can be confident about only answering those questions, only answering these questions. Okay. Our revision session today is focusing on the three aspects of residential status, scope of total income, salaries. But for all that, we need to know the taxes. So we will understand from the first chapter. Here we start with rates of taxation, and this is a chapter which is going to continue for a very longer time till the classes are over. So if at all at any place you are getting confused about the rates, about the computation, don't worry. As the class goes by, you will understand. As the days goes by, you will understand it. Okay. Now it is just a recollection of what has happened in the classrooms or in the studies which you have made. And I will, as far as possible, ensure to go slow. If at all any place you find me little faster, you can stop me, take the liberty of stopping me. Okay. Without wasting much of our time, I'm going into rates of taxation. Okay. Rates of taxation, and we are in the financial year 25-26. We are in the financial year 25-26. Why I am very specific is, next year, the preceding year, the law was different. The rates were different. Next year, the law itself is different. Okay. The law itself is going to be different next year. So, this rates of taxation is for the financial year 25-26. Okay. Broadly, our rates are divided into two. Okay. Slab rates of taxation, special rates of taxation. Slab rates of taxation, which is also known as normal rates of taxation, and special rates of taxation. The slab rates is now divided into two. The slab rates is now divided into two. We call one as concessional tax regime. We call one as concessional tax regime, where assessee needs to forego some benefits, some exemptions, and pay tax at a lesser rate. Or the other one is, assessee claims everything and pays tax at a different slab rate, which are little higher. So there are two things in our normal or slab rates of taxation. Concessional. If I go and ask someone, if the income tax department asks someone which tax system they have to follow. Repeating, if income tax department is asking someone which tax system they have to follow, and they are silent, they will fall under concessional tax regime. If the assessee is silent, if the assessee is not choosing, then they will fall under concessional tax regime. So the other name for this is default tax regime. Assessee being silent, default tax regime. This makes us understand that if I want to follow the other method, I should choose that method. If I don't choose, I will fall under concessional. So The other method is popularly known as optional tax method. The other method is popularly known as optional tax method, whereas the new scheme is known as default tax regime, concessional tax regime, new tax regime, whatever name you want to call it. That is applicable for slab rates of taxation. For special, both are same. For special, there is no difference. Both are same. We are very soon going to see. For surcharge, no difference except a small difference, I will tell you. And for health and educational cess, no difference. Where is the difference? In slab rates of taxation. We have optional concessional or optional default tax regime, or old new. Old new is not the right coinage, though it is popularly used, so we will call it as optional tax regime and default tax regime. Optional tax regime and default tax regime. Am I clear to you? Optional tax regime is there in Finance Act. Optional tax regime, the rates of taxation, is not there in income tax law. It is there in Finance Act. Okay, it is there as a part of budget. It is there as a part of bill. Okay, like that. Whereas concessional tax regime is there in section 115 BAC of Income Tax Act. For an individual, I am now speaking. Okay, it is there in section 115 BAC of Income Tax Act. That is also the second difference. Optional tax regime, the rates are not there in income tax law at all. The rates are outside the income tax law, that is known as Finance Act. Whereas concessional tax regime, the rates of taxation are very much part of income tax law, are very much part of income tax law. Is the class clear? Okay, so there are two tax regimes. One is known as optional, where assessee can claim all benefits, but the tax rates will be little higher. The second is assessee has to forego some exemptions and deduction, but the tax rate is lower. Okay, so there are two systems of taxation in computing tax. Tax will be computed on total income. Tax will always be computed on total income. Okay. In our optional tax regime, how does this work? In our optional tax regime, how does this work? The first few, the first sum which is not taxable is popularly known as basic exemption limit. The first sums which are not taxable is known as okay, up to the sum where tax will not be levied is known as basic exemption limit. Let me be clear from first itself. Basic exemption limit is only for income that is taxable in slab rates. BEL, basic exemption limit, is not there for income taxable at special rates. For example, now I say 2,50,000 is the basic exemption limit under the optional tax regime, and 4 lakhs is the basic exemption limit under concessional tax regime. Somebody has only one income, lottery income of 1 lakh. My dear friends, he has to pay tax. Even if it is just 1,000 rupees of lottery income, he has to pay 300 rupees as tax. Because BEL is only for income taxable at normal rates or slab rates. It is not applicable for income taxable at special rates. Now let me tell you what is the basic exemption limit under the optional tax regime. It depends on the age of the individual. If he is up to 60 years, it is 2,50,000. 60 to 80, 3 lakhs. More than 80 years, we call him a super senior citizen. The basic exemption limit is 5 lakhs. The basic exemption limit is 5 lakhs. Are you clear? Are you clear? Basic exemption limit is on the basis of the age of the individual. For senior citizen, extra 50,000. For senior citizen, super senior citizen, extra 2,50,000. So they have a slab of first 250 nil, first 3 lakhs nil, first 5 lakhs nil. That is their basic exemption limit. A small nuance now I will tell you. Okay. If somebody is born on 33/1966, what will be his basic exemption limit for your financial year? He would have claimed, he would have completed 60 years on 33/2026. What will be his basic exemption limit? 3 lakhs. 3 lakhs. It is not at the beginning of the year. Please understand, nowhere the law says on 1/4/25 he should be a senior citizen. He becomes a senior citizen anytime. So as on 31/3/26, if he is a senior citizen. Okay. If he is born on 1/4/1966. 31st March 26, he is 59 years, which is not correct. On 1/4/2026, he is entering 61. For this, there was a case, if you believe it or not. The judge asked 1/1/2025 to 31/12/2025 is 1 year. 1 year is not 1/1/25 to 1/1/26. 1 year is, okay. So even if he is attaining 60 years or 80 years on 1st April 26, suppose an examiner wants to, in your MCQ or something, wants to teach you, wants to test you your understanding of the calendar. Okay, remember, he completes 60 years, not on, he completes 60 years on 31/3/26. On 1/4/26, he becomes or enters 61. So the law says, if he is attaining the age on 1st April itself, give this exemption. Give this exemption. Am I clear to you? Am I clear to you? Basic exemption limit to 5 lakhs is 5%. Here not applicable because basic exemption itself is 5 lakhs. Next is 20%. Next is 30%. To make it more clear, what will be the tax up to an income level of 10 lakhs? 1,12,500, 1,10,000 and 1 lakh. Check this table whether you understand it. So this is the table of taxation, slab rates of taxation for individuals under the optional tax regime. Under the concessional tax regime, this completely changes. Before going into that rates of taxation, let me be clear to you. Under concessional, there is no senior citizen, super senior citizen classification. There is no senior citizen, super senior citizen classification. For everyone, the same rates of taxation, slab rates of taxation. There, the basic exemption limit is 4 lakhs. There, the basic exemption limit is 4 lakhs. Every 4 lakh increase, the tax will increase by 5%. 0 to 4, nil. 4 to 8, 5%. 8 to 12, 10%. 12 to 16, 15%. 16 to 20, 20%. 20 to 24, 25%. More than 24, 30%. Okay. Every increase, there is an increase of every 4 lakh increase, there is an increase of 5%. So you will understand that up to 24 lakhs, the tax will be 3 lakhs. So we need not wait to compute this. Up to 24 lakhs, the tax will be 3 lakhs. More than 24 lakh, it is 30%. So somebody says 30 lakhs, you just have to say 6 lakhs into 30% plus 3 lakhs. 6 lakhs into 30% plus 3 lakhs. Don't worry, as we go progress in the classroom in the various sessions of revisions, we will do tax working. I'm just giving you an idea now. More intricate questions we will keep working on it. Am I clear? Okay, right. The government, the intention of the government is to tax the higher category people, high net worth individual. That's how the law classifies them, and to give benefit to people who are earning lesser. This benefit is now passed on in the name of rebate. Okay, this benefit is now passed on in the name of rebate under section 87A. Under section 87A, rebate is a reduction from tax. Rebate is a reduction from tax. I will repeat this. Deduction is from total income. Deduction is from total income. Rebate is from tax. You find out the gross total income, give certain amounts, reduce certain amounts, that is known as deduction. You compute the base tax and reduce certain things, that is known as rebate. Rebate also varies based upon optional tax regime and concessional tax regime. Rebate also varies based on optional tax regime and concessional tax regime. Here the limit is 5 lakhs. Here the limit is 12 lakhs. Okay. Under the optional tax regime, limit is rebate can be claimed if the income does not exceed 5 lakhs. Once more, I am repeating this. Please be clear. If the income does not exceed 5 lakhs, exact 5 lakhs also you can claim. If the income does not exceed 5 lakhs, but whereas under the concessional tax regime, rebate can be claimed if the income does not exceed 12 lakhs. Here the rebate is 12,500 or actual tax, whichever is lesser. Here 60,000 or actual tax, whichever is lesser. Whichever is lesser. Okay. If you look at the slab also, 60,000 is up to 12 lakhs. So up to 12 lakhs, I don't want you to pay tax. Up to 12 lakhs, I don't want you to pay tax if you are under the concessional tax regime, default tax regime. So am I giving it the basic exemption limit as 12 lakhs? No. You will compute tax, claim it as rebate. Claim it as rebate. So it is not basic exemption limit, which is 12 lakhs. Basic exemption limit is 4 lakhs. Up to 12 lakhs, you need not pay tax. The one big difference you will find here is marginal relief, which is not there here, which is not there in the optional tax regime, which is only there in the concessional tax regime. What is marginal relief? Suppose somebody is earning 12 lakh 10,000. Had he earned 12 lakhs, he would not have paid any tax. By earning 10,000 rupees extra, now he will be paying a tax of 61,500. Which is not right. So the law provides something known as marginal relief. In the later part of the class, I will work out and show you how the marginal relief principle works. Okay, marginal relief is nothing but, okay, marginal relief is nothing but tax minus income exceeding 12 lakhs. Tax minus income exceeding 12 lakhs. How this works, I will tell you. Now, from the top, I am coming. 87A is for optional tax regime. If the total income does not exceed 5 lakhs, actual or 12,500. For concessional tax regime, 12 lakhs, actual or 60,000. Marginal relief is there for concessional tax regime. And remember, in both the cases, rebate cannot be claimed for income taxable at. I have only one income, lottery income, which comes to only 10,000 rupees. I have to pay 3,000. Whether I follow the old system or the new system, I cannot claim rebate for special tax regime. Is the class clear? Please remember, rebate cannot be claimed if income is taxable at special rates. If income is taxable at special rates. Is my online friends also clear? Rebate cannot be claimed if income is taxable at special rates. Online friends, are you clear?
Yes, sir. Yes, sir.
Shall I proceed? Shall I proceed? So what have I discussed with you? What is slab rates of taxation? What is rebate? Okay, slab rates under the both methods and rebate. Now come to what is special rates of taxation. Friends, only two types of income will enjoy that special rate: capital gains and winnings. Capital gains is split into three. Actually speaking, capital gains and winnings. Capital gains has something like this. For listed shares and securities, we are already paying a tax. For listed shares and securities which are transacted through the stock exchanges, we are already paying a tax to the central government, that is known as security transaction tax. We are already paying. 8 years back, since you are paying security transaction tax, you need not pay income tax. That was the law once, 8 years back. And then they revoked that. But they said, boss, I will give you the concession. Because you are paying some other tax, you need not pay the full amount of income tax. You pay it at a special rate. What is that special rate? If it is a short-term capital gain on which security transaction tax is already paid, rate of taxes 20%. Rate of taxes 20%. If it is a short-term capital gain on which STT is paid 20%, 111A plus 1, 112A. If it is a LTCG on which STT is paid, first 1,25,000 I will not tax. More than that, it is taxable at 12.5%. More than that, that is taxable at 12.5%. Now, LTCG rate itself is 12.5%. This point I am not discussing now. I will discuss while taking up capital gains. Okay, you will have it in the material. You will understand it. I will ensure I will work out sufficient examples to tell you how it works. But as of now, and winnings is 30%. Winnings is 30%. Once more repeating. STCG on which STT is paid 20%. LTCG always 12.5%. But LTCG on which STT is paid, first to 125 not taxable, exceeding that is 12.5 and winnings is 30. This is while computing tax. That 125 is not an exemption. Why I am telling you this? Let me give you an example also before making it clear to you. That my salary income is, let us take 50 lakhs. My LTCG under 112A is 1,25,000. Now my total income is 51,25,000. I am liable to pay surcharge. Very soon we will see. This 125 is not exempt. It will first be included in income. It is an income. While computing tax, I will take LTCG 112A as nil because it has not exceeded 125. It will be nil. Friends, there is a difference between exemption, deduction and non-taxable portion. Exemption or deduction will impact here. Non-taxable portion will only impact when tax is computed. When tax is computed. So while computing tax, I will reduce 1,25,000 and compute the tax. Generally, for your understanding, I am telling you that. So LTCG will be first 125 nil and 12.5. So normal slab rates of taxation, which is optional and concessional. Special rates of taxation is same whether it is optional or concessional. Now comes my surcharge. Now comes my surcharge. What is surcharge? Surcharge is computed on tax. Tax on tax is known as surcharge. Surcharge is not on income. Surcharge is computed on tax. If my level of income is not exceeding 50 lakhs, no surcharge. 50 lakhs to 1 crore, 10%. So if my income is 65 lakhs, my tax comes to 8 lakhs. My surcharge will be 8 lakh into 10%. 8 lakh into 10%. Remember, it is computed on tax. 1 to 2 crores, 15%. And then comes a small aspects of, again the same reason. You have paid some other tax. I want to give relief for you. You will wonder, sir, for dividend, for other things, what is the tax paid? We will see. You will understand it. Total income other than dividend, STCG, LTCG, both LTCGs, exceeds 2 crores but not 5 crores. On that income, 25%. On these type of income, the tax will only be 15%. This is exceeding 5 crores, 37 and 15. This is not there under the concessional tax regime. Under concessional tax regime, the maximum surcharge rate is 25%. As I said, you will understand. Okay. We are just starting with rates of taxation. We will more discuss it. First, I want to make you understand this, because all chapter we will also have computation of tax. We will also have a separate discussion on computation of tax. At that time, I will help you more on this. Health and educational cess is computed on tax plus surcharge, which is 4%. Which is 4%. Okay. Am I clear? From the top, I am repeating again. Our tax system is divided into two now. The optional tax regime. Why do I call it as optional? Because I choose that regime. Okay. They will say in the question, assessee opts out of concessional tax regime, which means he is under optional tax regime. Okay. So, under optional tax regime, basic exemption limit 2,50,000, 3 lakhs, 5 lakhs. First slab is up to 5 lakhs, 5%. So, approximately 12,500 or 10,000 in the case of seniors. Next slab, 20% common. Next slab, 30% common. Under the concessional tax regime, the basic exemption limit is 4 lakhs. Every 4 lakh increase, there is an increase of tax by 5%. And then up to 24 lakhs, the tax will come to 3 lakhs. More than that, it will be 30%. Remember, in both these cases, there is something known as rebate. Rebate is reduction of base tax. In the optional tax regime, up to 5 lakhs. In the concessional tax regime, up to 12 lakhs. Up to 12 lakhs. In the optional tax regime, actual tax or 12,500. In the concessional tax regime, actual tax or 60,000. One benefit I have under concessional tax regime is marginal relief. Marginal relief. What is the formula for marginal relief? Tax minus income exceeding 12 lakhs. Compute up to 59,990. Compute up to 59,990. After that, no marginal relief, because tax exceeding, income exceeding 12 lakhs will become 60,000. There will not be any margin relief. And my dear friends, in both the rebate, it is not available for special surcharge. We will understand more clearly in the future classes. As of now, in a nutshell, I have given you surcharge is computed on tax. If the total income does not exceed 50 lakhs, no surcharge. 50 to 1 crore, 10%. 1 to 2 crores, 15%. If the total income excluding dividend, STCG on which STT is paid, and both type of LTCG exceeds 2 crore but does not exceed 5 crore, 25% on such total income on the tax portion, 15% remains for the other things. And under the old tax regime, there is a 37% for more than 5 crores, which is not there under concessional tax regime. HEC is 4%. Read through the chapter in your WhatsApp or in your material. Just read through the chapter. Shall we progress? Online friends, shall we progress? Okay.
Yes, sir.
Everybody to have notebook, calculators. Everybody to have notebook, calculators. And I mean it by saying, if you work out only, you will get that speed. We should work out. Everybody to have notebooks and calculators. You need not download it. You will see in the screen and work out. You will see in the screen and work out. You need not download it. The screen will be helping you. First sum, MCQs. Nisha, aged 45 years, is a non-resident individual. For the current assessment year, she has the following income. LTCG on transfer of equity shares 1,80,000. STT has been paid on acquisition and transfer. So STT is paid. Out of this 180, what happens? First 125 is not taxable. Balance is taxable at 12.5%. Her other income is 275. Friends, yes, somebody's answer. I'll do one thing. Sorry. Now you'll have a separate screen where you can see. Can you check now? Can you check? Is it?
Yes, sir. Thank
Yeah,
you, sir.
yeah. Thank you. Other income is 275. Let me give me some time. 2.75, 1.85 makes it 2,75,000 plus 1,85,000 makes it 4,60,000. Can the assessee claim rebate? The assessee can claim rebate only for income taxable at normal rate. That 185, you cannot claim rebate. This is where the question gets the small aspect of it. Calculate the tax regime under default tax regime. Let it be default tax regime. First 4 lakhs not taxable. First 4 lakhs of what? Income taxable at slab rates. Whereas this 180 will not enjoy that basic exemption limit. This is anyhow taxable. This is not taxable. This is not taxable. So what is the tax? What is the tax? 1,80,000 minus 1,25,000 into 12.5% and HEC of 4%. Which is the correct answer? 7,150. 7,150. Repeating the answer for you all, my dear friends. Repeating the answer for you all. Okay. Remember, okay, other income is not taxable as it is lesser than basic exemption limit. LTCG alone is taxable. Out of that, 125 is not taxable. So 55,000 into 12.5% plus HEC. Your answer is 7,150. Your answer is 7,150. Have you all done this? Okay. So MCQ 1, B is the answer. MCQ 2. Mr. Neelakantan, aged 43 years, so not a senior citizen, provides you the following. Capital gain taxable under 112. What is the rate of taxation? 12.5%. Capital gain taxable under 111A. And then other income, we will see which regime he is in. What shall be the tax liability as per normal provisions, which means is under the optional tax regime. Now, quickly in our calculator, 190 plus 700 plus 16. Everything is in lakhs. 950 lakhs. 9 crore 50 lakhs. That means surcharge is going to come very slowly, very clearly. We have to understand. Let's go slow. Please go slow. But one thing very interesting, his income without including these two is only, so surcharge will only be 15% for everything. For everything, surcharge is only going to be 15%. Why? Had it been more than 2 crores, then whatever tax I get here, the surcharge will be 25%. Had it been more than 5 crores, 37%. By including that only it is more. By excluding that, it is not exceeding 2 crores. So surcharge is only going to be 15%. Now, all of us, one more thing. Out of the 60 lakhs, for first 10 lakhs, what is the tax? 1,12,500. He is a non-senior citizen. I mean, he is a not a senior citizen. So 1,12,500. For 50 lakhs, it will be 30%. Do it. Do it in your notebook properly and tell me. Do it in your notebook properly and tell me. 112 is 12.5%, 111A is 20%, other income 60 lakhs, out of which first 10 lakh, 1,12,500, balance 50 lakhs into 30%, then surcharge will only be 15% because income has not exceeded 2 crores. Other income has not exceeded 2 crores. So surcharge will only be 15%. Adding that, you will find HEC. If you are unable to understand computation of tax, don't worry. I will again teach this chapter more detail. Now we are just having a small roundabout calculation of all these things. So without any worry, please compute. Those who are able to, please compute. Others, don't worry. One crore 90 lakhs into 12.5%. 7 crores into 20%. On that 60 lakhs, 50 lakhs into 30% plus 1,12,500. Total this, add 15% surcharge, add 4% HEC. Can I? Can I? Can I? Okay. Repeating the answer, I am getting 215.13. 215.13. That is option C. The total income other than 112 and 112A has not exceeded 2 crores. So surcharge will be 15% across. So it will be 12.5% of 1 crore 90 lakhs, 20% of 7 crores, and income taxable 50, that's 60 lakhs. Are you getting this answer of 2.5.13? Are you getting it?
Yes, sir.
Anybody not getting it? You got it, Darshini. Okay. Priyanka, Kan, you all got it. Raja, you got it. 215 point, no, I request you, I'll see this, but I kindly request you to unmute and tell me if you have a doubt. Okay. Shall I move on? I hope all of us got this. Okay. Mr. Baba, aged 65 years, has a total income of 3 crore 20 lakhs, consisting of LTCG under 112 57 lakhs, taxable at 12.5%. LTCG under 112A 65 lakhs. First 125 not taxable. Remaining 63 lakhs 75,000 taxable at 12.5%. And other income is only, which means the, like last question, the other income has not exceeded 2 crores, so surcharge will only be 15%. What would be the tax liability under, which means that extra benefit of senior citizens are not there. This 198, first 24 lakhs, the tax is 3 lakhs. The balance 174, the balance 174, 198 minus 124 is 30%. This you know is 12.5%. This you know first 125 is nil, remaining 6375. Surcharge is same 15% because it has not exceeded 2 crores, the other income and HEC. Go. The right answer B, 84 not 7 130.
So what is the answer, sir? Is it B? Sir?
So B 84 not 7 133 is the answer. 84 lakh 7,133. For those of you who are unable to understand, I assure you that we will again do, because I have to say you how agricultural income is added, all those things. I will keep doing taxes. Don't lose hope. Don't feel that you are not understanding. You will. Now, this is not MCQ, proper working questions. Assessee having income from salaries and house property declares a total income of 940 under the optional regime and 1240 under the default tax regime. Okay, write down, start. Computation of tax. All of us start. Computation of tax hyphen optional tax regime. Computation of tax hyphen optional tax regime. Particulars, amount, inner column amount, outer column amount. Total income in the inner column 9,40,000. Total income in the inner column 9,40,000. Base tax. Base tax, my dear friends. 4,40,000 into 20% plus 12,500. Remember, first 250 not taxable, next 250 12,500, after that 4,40,000 into 20%. 4,40,000 into 20% plus 12,500, the answer in the outer column. It will come to 100, 100,500, 100,500. Add HEC at 4%. Add HEC at 4%. So what is the tax? What is the tax? 1,04,520. Under the optional tax regime, 104,520. Under the optional tax regime, 104,520. Have you completed this? Have you completed? Now I am going to the next concessional tax regime. Now I am going to concessional tax regime. Before starting, something interesting. The total income under concessional tax regime is 12,40,000. Marginal relief will come. Marginal relief will come up to 12,59,990. Marginal relief will come. What is marginal relief? Very simple. Don't ask him to pay tax more than 40,000. Income is 1240. Had I earned 12 lakhs, how much I would have paid it as tax? Nil. By earning 1240, I should not pay a tax more than that. Itself is a loss to me. Whatever I earned, I gave it to the government. Apart from that, I'm going to also give HEC. Don't ask me to pay more than 40,000. Very slowly. Total income, inner column, 12,40,000. Total income, inner column, 12,40,000. Friends, base tax, 40,000 into 15% plus 60,000. Once more repeating. First 4 lakhs nil. Next 4 lakh 5%. So 20,000. Next 4 lakh 10%. So 40. 20 plus 40 makes it 60. Balance 40,000 into 15%. How much I am getting? 66,000. Understand marginal relief. What is the formula? Tax minus income exceeding 12 lakhs. What is the tax? 66,000 minus income exceeding 12 lakhs is 40,000. So I will give him a marginal relief of 16,000. Now my tax will come to 40,000. I should not ask him to pay more than 40,000. Because had he earned 12 lakhs, he would have not paid any tax. By earning more, don't ask him to pay 66,000. Why will I pay? So marginal relief is tax minus income exceeding 12 lakhs. So you will get 66,000. That is the tax portion minus income exceeding 12 lakhs is 40, 16,000. This is marginal relief. Now you will get 40,000. Sorry, 26. Sorry. 26,000. Now you will get 40,000. HEC, add HEC, okay, 1,600, 41,600, 41,600. Repeating, marginal relief is tax minus income 26,000. So under the old tax regime, I would have got 1,04,520. Under the concessional tax regime, 40. Even though the income is more by 3 lakhs, but still I pay a lesser tax. Still I pay a lesser tax. Any doubts in this? Any doubts in this? You're clear? Okay, you're clear online friends. You're clear, right? Question B. Income from salary 880 under optional and 1150 under concessional. LTCG on sale of jewelry 50. Okay. Before starting itself, let me be clear. First, under the optional, income from salary 880. So up to 5 lakhs 12,500, remaining 3 lakh 80,000 into 20%. LTCG 12.5%. 12.5%. You know how to compute the tax. Now coming to concessional. Concessional. Remember, the total income has not exceeded 12 lakhs. 1150 is my salary income. 50,000 is my LTCG. Total income has not exceeded 12 lakhs. So no tax payable. Is my understanding correct? No. No. For this 1150 only I can claim rebate. For that 50,000, I need to pay tax. Rebate cannot be claimed for special rates of taxation. Rebate cannot be claimed for special rates. First workout concern option. First workout option. Under the optional tax regime, 3,80,000 into 20% plus 12,500, 50,000 into 12.5%. Add these two things and give me the tax.
TCG,
12.5%.
it has not exceeded.
On which STT paid then that? How much? Add HEC. Where will rebate come under the old tax regime, under the optional tax regime? Income has exceeded 5 lakhs. Rebate will not come under optional tax regime. 90?
98,500.
Friends, under the optional tax regime, we are getting 98,540. Under the optional tax regime, we are getting, you are all getting, okay, 98,540. I am going to start working on concessional tax regime. Please start under concessional tax regime. Under concessional tax regime. Please start under concessional tax regime. Income taxable at normal rates, inner column 11,50,000. Inner column 11,50,000. Income taxable at normal rates. LTCG under section 112, 50,000. 12 lakhs. 12 lakhs. Okay. So for this 1150, the tax will be, friends, for this 1150, the tax will be 3,50,000 into 10% plus 20,000. First 4 lakhs nil, next 4,20,000, balance 3,50,000 into 10%. 3,50,000 into 10%. So that will be 35,000 plus 20, 55,000. For this 50,000, the tax will be 5,000. No, 6,250. 6,250. So 61,250. 87A rebate will be only 55,000. 87A rebate will be only for income taxable under normal rates. So only 55,000. 87A rebate will be only for income taxable. You cannot claim it for special rate. Even now I agree that the total income has not exceeded 12 lakhs. You are eligible for rebate, but not on the entire quantum of 60. It is restricted to 55,000. It is restricted to 55,000. So your tax will be 6,250. Add HEC, you will get 6,500. Remember, under concessional tax regime, total income has not exceeded 12 lakhs. Assessee can avail rebate. However, rebate is not available for income taxable at special rates. So only for salary income you can claim it. Only for salary income you can claim it. Is it clear? Is it clear? Yeah. Any doubts? Any doubts? The third question is, LTCG under 112 is 550, 112A is 450. Whichever regime, the same answer. Whichever the regime, the same answer. No rebate also. No rebate also. So this 550 is taxable at 12.5%. Out of this 450, first 125 is not taxable. Remaining amount of 225 or whatever it is taxable at 12.5. The second MCQ. What is the rate of surcharge if the income is between 1 crore to 2 crores? 15. Income other than these three, total income exceeds 2 crores. But other than these three, it does not exceed 2 crores. It continues to be 15%. Repeating, I have a LTCG of 1.8 crores. Income other taxable under normal rates is 70 lakhs. My total income now is 2.5 crores. Normally, I should have gone to 25% surcharge level. But my total income other than these three has not exceeded 2 crores. So I continue the previous slab, 1 to 2 crores of 15%. Okay.
Special rate இருந்துச்சுன்னா basic exception limit எடுத்துக்கலாம் இல்லையா? Unexhaust exemption.
That is lost.
Oh,
If you have studied in the previous years,
okay.
you could have taken. This year onwards, no.
Oh,
You cannot take it. For example, this question we worked out. The first question we worked out. 275. Okay. default tax regime தான்.
Okay.
another 125 நான் adjust பண்ணலாமா அந்த 180 ஓட பண்ண முடியாது சார் இப்போ. You cannot do because no more special rates of taxes are in henceforth special rates only. Neither unexhausted basic exemption limit nor rebate can be claimed against that. Till last year it was different. Okay. Okay. Shall I move on? Shall I move on to the chapter of residential status? To the chapter of residential status. Okay. Let us be clear. Our question is on individuals only. Maximum once or twice they have asked the HOF. Firm, company, AOPs are not in our syllabus at all. So don't worry. Let me talk about individuals. Listening only. Concept listening. We will work out the solutions later. There are two conditions. Basic condition, additional condition. Each condition has two subrules. Each condition has two subrules, and these four things put together, we are going to determine the residential status of individuals. Okay. Very slowly. Basic condition 1 is simple. 182 days or more in India. If you are here for half the year, you are my man. Repeating, if an individual is here in India for at least half of the year, 365, so 182 or more, you are a resident. Basic condition 2 has two parts. 60 days in the previous year plus 365 days in the 4 years preceding the previous year. 60 days in 25-26, 4 years preceding 24-25, 23-24, 22-23, 21-22. In this 4 years, 365 days or more, you satisfy the basic condition. You satisfy the basic condition. So the in-between term is or. Any one basic condition, if you satisfy, you become a resident. You become a resident. But then we gave some exceptions to this basic condition B. We gave some exception. Indian citizen leaving India for employment purposes. Indian citizen leaving India for employment purpose. Member of a ship crew. Okay. And third, Indian citizen and person of Indian origin visiting India. For these three categories of people, basic condition 2 is not applicable, which means they have to satisfy only one basic condition. That is the first basic condition. Okay. I am repeating. Let's go slow. There are two conditions. Basic condition 1 straightforward and simple. Basic condition 1, straightforward and simple. 182 days or more during the relevant previous year. For all of that, it is 25, 26 if he is here. Basic condition 2 has part A, 60 days or more in 24, 25, 26. 365 days or more in the 4 years preceding the relevant previous year. Am I clear? Exception to basic condition B, which means you need not check it. For whom? For individuals leaving India for the purpose of, that word is important, not a leisure trip, not a business trip. My intention is I got a employment outside India. I'm going to permanently go there to take up that employment. For Indian citizens and person of Indian origin visiting India. For member of a ship crew. For the above 3 categories, basic condition B is not applicable. Am I clear to you? Though this Indian citizen and PIO, later I am going to talk about an exception. As of now, you need to understand what I need to check. So when a question is there, first in 25, 26, you will take the calculator and check how many days. Is he falling under any of these 3 criteria? Check only one. If he is a non-resident, if he is not an Indian citizen, etc., then check B condition also. Any one basic condition satisfying, he becomes a resident. Take date of arrival and date of departure also as he is in India. Take date of arrival and date of departure as he is in India. Is the class clear? Is the class clear? Okay. So, basic condition 1, basic condition 2. Once a person satisfies a basic condition, sometimes what happens? I have never been in India. Last year I came to India for staying for some 5 months. Due to some reasons, it got extended to 7 months. And I don't have the intention to continue here for a longer time. So I am known as an accidental resident. Intention is not to be a resident. Accidental resident, that is a normal English term. Law calls it as not ordinary resident. His intention is not to be in India, to be an ordinary resident of India. So came 2 additional conditions. In at least 2 out of the past 10 years, he should be a resident in India. Who is a resident? One who satisfies basic condition, one of the basic condition. In at least 2 out of the past 10 years, he should have satisfied one basic condition. Are you understanding? And the second is, he should be in India in the past 7 years for 730 days or more. The sanctity of 730 is 2 years. Need not be continuous. 730 days or more. Okay. So a person who has never been in India, 1 year alone he satisfies this 182 days or more condition. I don't want to give him the ordinary resident status, not ordinary resident. A person who has satisfied the basic condition, has been in India for more than 2 years as the resident, has been in India for 730 days or more in the both the years in the past 7 years, boss, You are my man. ROR. Okay, here it is and. That is, both the condition needs to be fulfilled. Additional condition. He should be a resident. We all know who is a resident. One who satisfies the basic condition in at least 2 out of the 10 years, 730 days or more in the 7 preceding years. If an individual satisfies one and both additional condition, ROR. Only satisfying basic condition, not satisfying one or both the additional condition, accidental. Not at all satisfying the basic condition. Not at all satisfying the basic condition, non-resident. So there are two basic conditions. First basic condition, very simple calculation. Take the calculator, date of arrival, date of departure. Okay. And if he is in India for a long time, 1st April to the date of departure. Okay. Check whether he is an Indian citizen leaving for employment. Indian citizen or person of Indian origin. Parents, grandparents born in undivided India. So the grandparents before partition, they would have been born. Parents, grandparents born in, so he will be known as a person of Indian origin. Member of a ship crew, because major time they spend in sea. I don't want them to give the, because we all know ROR, everything is going to be taxable. I don't want to do for them. So these three categories you need not check. Am I clear to you? Am I clear to you? So then additional condition. This is the residential status of individual. Okay. Two basic condition, two additional condition. Always second additional condition is easy to check. And be sure, if somebody is satisfying the second, they will also satisfy the first. 7 years, 730 days. Here I am asking in past 10 years, 2 years. So anybody satisfying the second basic condition will always satisfy the first. So the easiest additional condition always to check is second. Is the class clear? Online friends, are you clear? Are you clear about these things?
Yes,
Are you
sir.
clear? Online friends?
Yes, sir.
Yes,
Yes,
sir.
sir.
Yes, sir.
Thank you, Nitya. Thank you. Okay. Remember, second additional condition alone, first check. Basic condition is for a member of ship crew, there is a special provision under our law. For a member of a ship crew, there is a special provision under our law. Why this special provision? Why this special provision? The reason is very simple, my dear friends. I'm little considerate about him. A ship which has a foreign destination. It's not for a member of a ship crew of an Indian Chennai to Visakhapatnam, Visakhapatnam to Mumbai, Mumbai to Visakhapatnam. I'm only talking about a foreign bound ship. The destination is outside India. What happens in shipping industry? Because we need to understand it along with that. If an individual walks in, he cannot walk out till the ship comes back to the originating point, wherever it starts. That is the shipping industry now. They say, boss, you come in, stay in the ship for the round trip. So Okay, Mr. X gets into the ship. The ship might still be in India, but the law says he has gone outside India because he cannot. The ship will take some days to cross the Indian boundaries, Indian borders, 12 nautical miles. You understand, right? This is the problem we have. Majority of the ship crew people, they walk into the ship. For the next 1 week, the ship will not start because they have to make lot of arrangements inside. It's not like our office jobs where after 5 o'clock I'll go home and come. That option is not there. I have to stay inside the ship only once I have walked into the ship. After 7 days, the ship commences journey. Probably it will touch 1 or 2 Indian ports and then leave India or leave it. So it will take another 1 week, 10 days for them to leave India. And once it comes into the Indian territory also, they cannot jump out. It has to come to a particular shore or a particular port where he entered the ship. And then all the formalities has to be completed. Then only he can come out of the ship. That is the norm of shipping industry. Signing in, signing out. Income tax law considers this also. Income tax law says, I understand, boss. We will do one thing. The day you walk into the ship and the day you are walking out of the ship, this period I will consider that you are outside India. From the day you are walking into the ship, signing in, to the date you are walking out of the ship, even though the ship is in India, you are also physically in India, but you don't have the option of coming out. So I will consider it as if you are outside India for a foreign bound ship. So till this date and from this date, you will be in India. Suppose I walked in, today 17/5. So till 16/5 only I am in India. Suppose I come on 1/11, from 2/11 only I am inside India. Okay, once more I am repeating this special provision. Already the second basic condition is not applicable for them, we know. For computing the period in India, date of signing in to the date of signing out will be excluded. In other words, till the date before going into the ship and from the next day of walking out of the ship, he will be considered as he is in India. Is it clear? Is it clear? This is for a member of a foreign bound ship. Only for a foreign bound ship, not for an Indian local ship. Okay. For all others, HUF, firm, AOP, the word is control and management. You have the control and management in India, either wholly or partly. Then you are supposed to be a resident assessee. Control and management wholly outside India, which is very rare in these cases. You are a non-resident. Okay. For a company, we use a different term called POEM, place of effective management. Okay, as I said, that's not in our entire syllabus. So understand HUF alone extra. If the control and management is in India, and the karta satisfies, karta being the main person who leads, then ROR. If control and management is in India, karta does not satisfy. If control and management of the HUF is wholly outside India, which is very rare, HUF will be treated as non-resident. Non-resident. Okay. Please read page 4 and 5. Please read just page 4 and 5. Just 4 and 5 is sufficient. If you don't understand, ask me. Clear? Am I clear? Okay. Why is this residential status an important aspect of it? Only for one reason. Then only I know whether to tax him or not. Residential status just establishes the link between the taxing nation and taxed person. Between the taxing nation and the taxed person. If he is my man, when I say my man, I mean ROR, resident and ordinary resident. If he is my man, then the popular wordings, எவ்வளோ அடிச்சாலும் தாங்குவோம். Okay? Tax him for all the income he is earning. Wherever he earns, however he earns, it becomes taxable if he is my man. If he is a non-resident, I need to be cautious. Please understand, because I all will, as a general public, what they'll feel. Why can't they tax non-resident everything? How can you tax non-resident everything? He will never come to India. He will not invest. My intention is to bring foreign investment. To bring. So, only if there is a Indian nexus, I will tax him. Either he should have received the income in India or he should have earned the income in India. Income from dividend of Indian company. That means he is earning the income in India. Income from sale of assets located in India. Income from house property in India. In all these cases, you tax him. Mr. Sundar Pichai, even though he is Indian citizen, he is not a resident in India, earns house property income from US. Can I tax him? Never can I. So a non-resident is taxable for income received in India, income earned from India. Receipt test, source test. The source of income is India. We are going to elaborately discuss it. I'm just throwing some base ideas. And RNOR, that accidental resident, apart from non-residence taxation, if at all he is doing any business outside India, but he is controlling it from India, it becomes taxable. My dear friends, a chartered accountant firm opened an office in Dubai. They are controlling it from India. I have a Dubai client. I have a client in Dubai. I am servicing it from India. It is taxable in India. So what I did is I opened a Dubai office. Asked my client to pay it to Dubai office. And said, no. I'm not earning income from India. The law said, must wait. What instructions are you giving from India? Every working paper, every control you are having in India. Business or profession outside India, but controlled or managed from India, you pay tax here. You pay tax here. RNOR. They are also like non-residents only, but one more income is taxable in India. We call this as scope of total income. What type of income, to whom it is taxable? Received in India, accruing or arising from India, for everyone taxable. For everyone taxable. Nobody is spared here. Deemed to be received in India. Don't worry. PF balance, encashing of PS balance, excess of interest over 9.5% in RPF, pension, URPF to RPF conversion. They call it as deemed to be received in India. Very small area, don't worry. Deemed to accrue or arise, we are going to discuss, little elaborate this, please wait. Income from business or profession outside India, but managed from India. Taxable for RNOR, not taxable for NR. I'm not worrying about ROR. I told you ROR, wherever he earns, however he earns, it is taxable. Rental income, dividend, all type of income which is accruing and received outside India, for both of them, not taxable. Not taxable. Only income earning is taxable. You cannot tax an income twice. I earned the house property income outside India, ROR, taxable. Then brought the money into India, again taxable. That's not correct, no. Income earning only is taxable. Inward remittances, bringing money from outside India to inside, India is never a taxable event. Remember, for ROR, global income. For a NR, received and accruing or arising. For a RNOR, other than that, business or profession. And only income earning event is taxable. Using the income after earning is not taxable, even if they use the word inward remittance of past untaxed income. Don't worry about that untaxed. What he did is inward remittance. He brought the money from outside India. Not taxable. Am I clear? Am I clear? Friends, RS plus STI, one question sure. RS plus scope of total income, one question, 7 marks. Sure. Okay. Now I am going to talk more to you about deemed to accrue or arise in India. What is the deemed to accrue or arise in India? We have 5 heads. We will go headwise. Salaries. Where is it taxable? Salary is taxable at a place where services are rendered. Repeating, salary is taxable at a place where services are rendered. Infosys India sends Harita, their employee, to US on site. Can I tax her income in India when she is in US? No. Salary is taxable at a place where I purchase a machine. I purchase a machine. For installation, the German company sends 2 people, 2 engineers to India. For 6 months, they will stay in India and install the machine. For this 6 months, their salary is taxable in India. Why? Services are rendered in India. Once more, we will say salary is taxable at a place where. Clear? One exception. Indian citizens working in High Commissioner or Ambassador office outside India. Indian citizens working in High Commissioner or Ambassador office outside India, their salary is taxable. Even though they are rendering services outside India, but Indian government pays them, so their salaries are taxable in India. Only salary is taxable. Allowances and perquisites are exempt. From the top, where services are rendered. Normally, salary is taxable only at a place where services are rendered. If a NR does services in India, salary becomes taxable in India and vice versa. Indian citizens, if they are working in embassy or high commissioner's office outside India, that salary is becoming taxable in India. Only for salary, not for allowances and perquisites. Not for allowances and perquisites. Is the class clear? Is the class clear? Okay. House property. If it is located in India, taxable. Located outside India, not taxable. This I am speaking only for non-resident. For a resident, everything is taxable. Okay. This discussion is only for non-resident. Okay. House property. Business or profession. Very slowly. Habitually has business connection in India. habitually has business connection in India. This morning you woke up at 5:30. Is it a habit? No. Every morning I wake up at 4:30. Is it a habit? Habituate means regularly, one-time activity. Don't call it as habit. Don't call it as habit. Habitually has business connection. Enters into contract, negotiates terms, etc. Then I will call it as deemed to be in India. Habitual practice of settling contracts, storing delivery goods, and significant economic presence. Download of software or user exceeds 2 lakhs. WhatsApp, Instagram, Microsoft 365. We download WhatsApp user interfaces exceeds, then these people have business connection in India. Mere purchase and export is not business connection. If I purchase and export, it is not business connection. When I send this notes again, I will add that point. I missed to write it. Mere purchase and export is not a business connection. Okay? Okay? Am I clear to you? Capital gains. When it will be treated as accruing in India. If the asset is an Indian asset, I sell land in India. Provision is for non-resident. Resident, forget it. I sell land in India. Is it taxable? Yes. I sell shares of an Indian company. Yes. Even though the sale can take place outside India also, but for a non-resident it is taxable in India. I sell rights of an Indian license, taxable in India. Okay, where the asset is located in India, or it could be shares of a foreign company which has assets located in India. The foreign company has assets in India. That company shares, if I sell also, it is like selling the assets of, indirectly it is like selling the assets of India. Are you clear? Once more, salary at a place where services are rented. House property if it is located. Business or profession, habitually concluding contracts, significant economic presence. The exception, which I have not written here, I missed it out, is mere purchase and export of goods does not amount to business connection. Capital gain, Indian assets plus shares of a foreign company which has Indian assets in India. Shall we go to IFOS? Major income which are speaking about is Kanu.
Sir, can you again explain the second point of capital gain?
Yes, Kanu. X Incorporation is a foreign company. Their balance sheet is equity shares. Let us take 10 lakhs. Okay. Asset in India 10 lakhs. Now, Mr. A, who is having this equity shares, who is a non-resident, sells these shares. He is not selling the shares, He is selling assets in India because the company only owns the asset in India, and the shares that are sold will be deemed to be as if the assets in India are sold, because from me it is going to some other person. I have shares, so I'm a non-resident. I have shares in a company which owns asset in India. I sell my shares to you. By selling the shares, I am not selling the shares of a foreign company because along with that goes the assets of Indian company. So if a shares of a foreign company which has substantial value located in India, then it will also be taxable in India.
Okay.
Interest. I'm only speaking about non-resident. Remember, if it is from government of India, taxable. If it's from a resident of India, taxable. Assume, for example, I am also a non-resident. Harita is also a non-resident. I gave loan to Harita, asking her to invest in business or profession in India. Loan by one non-resident to another non-resident with the direction that it should be used for, then Harita pays me interest, no? Though it is paid in London, though it is paid in New York, it is taxable in my hands because I gave the loan with the direction that it should be used in India. I gave loan to Harita. Harita purchased a house property in India. Not taxable in my hands, the interest. Only for business or profession in India. Remember, we are only speaking about what is taxable to a non-resident. Don't talk about, we are not talking about residents. Non-resident. Non-resident receives interest from government of India. Is it taxable? Non-resident receives interest from a resident Indian. Is it taxable? Normally, non-resident receiving loan interest from another non-resident, nothing to do with India. Nothing to do with India. Except one circumstance. At the time of giving the loan, you don't look at two individuals here. Citibank gives loan to Google Incorporation. Both are America, sir. But the loan is given for starting Bangalore office. But the loan is given for starting their Bangalore office, where the loan is given with a specific direction that it should be used in for business or profession in India. Then the interest paid by Google Incorporation to Citibank, for Citibank, the receiver of the interest, it is taxable in India. Are you understanding? Are you clear? Okay. Same for royalty and technical fees. Interestingly, the word business or profession is not there, which means even if it is for non-business purpose, nobody is going to use royalty or fees for technical non-business. But even if it is for non-business purpose, it becomes from government of India, from another non-resident, for the right to be used in India. It need not be for business or profession. It is taxable. So what is taxable for a non-resident? Only we saw salaries, house property, business or profession, capital gains, interest, royalty and fees for technical services. Apart from this, if a non-resident gets a gift from resident, if a non-resident get gift from resident and the value of gift exceeds 50,000, the whole of the gift becomes taxable. Gift received by non-resident from resident or even from a resident, not ordinary resident. Am I clear to you? Am I clear to you? Okay, just study this before we go to the next one. Just have a read through. Can I? Can I? Can I go to a special provision now? Is there a possibility that a person is not a citizen of any country? I mean, resident of any country? Yes, today it is possible. Cartel of countries. From Singapore to Chennai, you can come faster than Bangalore to Chennai, even by flight. From Singapore to Chennai, you can come faster than Bangalore to Bangalore. You have to necessarily go to that place to understand what I am telling. Okay? 4 kilometers away. That's what my friend will say. And 4 kilometers away from this, oh, then I can easily make it. No, no, not possible. He will say minimum 1 hour. 4 kilometers away. He will say minimum 1 hour. Okay, so you can imagine. So today, India, Sri Lanka, Nepal, Singapore, Malaysia, these are cartel of countries where traveling can happen within no time. If I want to ensure that I am a non-resident in all the countries, I can do that. I can do that. I need to stay less than 182 in the 4 years, less than 365. Yes, that is possible today. Very much possible. This is India I'm talking. Europe, every country is a railway station. I'm not joking. Netherlands, Switzerland, France, Germany, people travel by train. People wake up in Netherlands, go to France, work and come back night to Netherlands. Okay? So if they want to be a non-resident everywhere, they can. What is the problem? Nowhere you will declare your global income. So came 2 two special provisions. One, if you are an Indian citizen and your Indian income, okay, exceeds 15 lakhs. I'll talk about Indian income. Okay. You are not paying tax anywhere. You are not a domicile citizen anywhere. You are a deemed resident of India. You are a deemed resident of India. This is under 6A of the law. What are all the conditions? You should be a Indian citizen and you are not a resident anywhere else. Anywhere else. And your Indian income exceeds income received in India, income accruing from India, business or profession outside India, managed from India. What is Indian income? Received, accruing, business or profession, but managed from India. Where you are an individual, not a resident, your Indian income exceeds 15 lakhs, then you are deemed to be a resident in India. We also saw something here. I told you for this category of person, there is going to be one exception. That is what I am talking here also. Special provision for Indian citizens or person of Indian origin. Which normally the second basic condition is not applicable. However, where such individuals' Indian income exceeds 15 lakhs, then instead of 60, it will be 120. 120 plus 365. In both the cases, the taxation will be levied treating you as RNOR. In both the cases, deemed resident and this case, treating you as RNOR. Very slowly, what is Indian income? Received in India, accruing or arising in India, and business or profession outside India, managed from India, is known as Indian income. If your Indian income exceeds 15 lakhs and you are an Indian citizen, not a citizen or resident anywhere else, you become deemed resident. If your Indian exceeds 15 lakhs, you are an Indian citizen or person of Indian origin. Normally, second basic condition is not, but here I am going to make you applicable. But I am not saying 60 plus 365. Nor I am saying it is not applicable. I am bringing in between a rule called 120 plus 365. Very often, this is now getting questioned. Very often, this is being questioned by our institute. Patiently read through the last part so that we can go and start working out the questions. Patiently read through. Shall we? Shall we? Shall we? Okay. Keep this in your mind. When we practically apply, you will be understanding more. Again, paper and pen. in your hand, to compute, calculators in your hand. Okay. I'm in page number 3 of your material. Slowly. Mr. Rajesh, aged 53 years, and his wife Soumya, aged 50 years, are citizens of country X. Don't bother where they are citizens. They are living in country X. They are not liable to tax in country X. Both of them have keen interest in Indian culture. Rajesh's parents and grandparents were also from country X. Is Rajesh a person of Indian origin? No. Rajesh's parents and grandparents were born in country X. So Rajesh is never a person of Indian origin. Soumya visits India along with Rajesh for 4 months every year to be with their parents who were born in Delhi and living in Delhi. Okay. How many months they are coming? So how many days? 120 days. 120 days they are in India. Okay. Remember. During their stay in India, they organize cultural program. Income of Rajesh and Soumya is 18 lakhs and 16 lakhs respectively. What is the residential status of Rajesh and Soumya? Again, we will read it. They are not liable to tax income. Both of them have claimed. Rajesh's parents were born. Soumya visits India along with for 4 months every year to be born with their parents. Okay. Soumya's Indian income also exceeds. Okay. Right. Patiently. First, what is the residential status of Rajesh? Why?
Second condition not applying.
எப்படி கண்ணு? How many days?
120 days.
In the past 4 years? 480 days. Remember, he is not a person of Indian origin. Rajesh is not a person of Indian origin. Rajesh is born there. Okay. They are birth. Rajesh parents or grandparents are born there. So for Rajesh, is he satisfying the first basic condition? I mean, second basic condition? Is he satisfying the second basic condition? And past 7 years, 120 into 7. So Rajesh is a ordinary resident. ROR. Rajesh is a ROR. Are you clear? Can I repeat this? Rajesh comes to India for 4 months. Rajesh is not an Indian citizen, not a person of Indian origin. Rajesh comes to India for 120 days every year. He satisfies second basic condition, additional conditions. So he is a ROR. And now speaking about Soumya. Normally, she need not be checked for second basic condition. But her Indian income exceeds 16 lakhs. So that 120 plus 480, she is satisfying the second basic condition. What provisions will be applicable to her? RNOR. She is not normally a citizen. Due to special condition, she gets satisfied. So RNOR. Now let us read. Both are resident and ordinary resident. No, both are non-resident. Mr. Rajesh is resident but not ordinary resident. Mrs. Soumya is a RNOR. Mr. Rajesh is a ROR. Mr. Rajesh is a ROR. Mrs. Soumya is a RNOR. Is a RNOR. Both of them stay here for 120 days. Rajesh is neither a resident nor a person of Indian origin. He is satisfying basic condition and additional conditions. Soumya is a person of Indian origin. Normally, second basic condition is not applicable for her, but her Indian income exceeds 15 lakhs. Hence, it becomes applicable. Irrespective of other facts, she'll always be treated as RNOR. Read the answer and see whether you're understanding. Clear? Is it clear? Okay. Determine the residential status of Sundaram HOF, which carries out its transaction in Malaysia, partly controlled from India. So HUF is a resident. But to know whether it is a ROR or RNOR, I need to know that of the Karta. The Karta visits India on 1/6/25 and leaves on 10/2/26. He has not visited in the past 11 years. How many days Karta stays in India? Can you quickly compute? Karta in India is equal to June 30, July 31, August 31, September 30, October 31, November 30, December 31, Jan 31, Feb 10. 255. Okay. Additional condition only I'm checking. Sorry. In the past 11 years, he has never visited India. So both the additional conditions are not satisfied. So the HUF will be resident but not ordinary resident. Sorry, I need not check his stay in India. HUF is partly controlled from India and Karta has not fulfilled any of the additional conditions. So RNOR. RNOR. Very good question. Read it and try it. Otherwise, I'll explain. Patiently read it. The question is, who is a non-resident? Work பண்ணி பாருங்க. Take the calculator or take a notebook, work பண்ணி check. How many days in 25-26 Bob is here? Bob is not an Indian resident, Indian citizen or PIO. He satisfies the second basic condition, so he can never be a non-resident. Samrat, born and settled in USA, visits India for 100 days to meet his parents and grandparents. Born in India, so he is a person of Indian origin. For them, the second basic condition is not applicable. So he is a non-resident. He is a non-resident. Mr. Joseph, an American scientist, left India to his home country for employment. He stayed in India for how many days in 25-26? How many days? April, May, June, till 1st of July. 92 days. 92 days. Is he satisfying the second basic condition? Is he satisfying the second basic condition? First basic condition he is not satisfying. Is he satisfying the second basic condition? Is louder, Kannu? For whom it is not applicable, Kannu? Is he an Indian? That is where the twist of the question was. Mr. Joseph, an American scientist, he came to India for, so second basic condition is applicable. He is not satisfying that. He is satisfying that. So he is also here also a resident, here also a resident. Question is, who is a non-resident? Only Samrat is a non-resident. Once more I am repeating. Our mind gets tuned to certain things. That Joseph is an American citizen. So for him, second basic condition is only Indian citizen going out of India for employment purposes. That exception is there. He is an American citizen. So second basic condition we should check. He satisfies the second basic condition. He is also a resident. Bob has come for 101 plus 480 in the last 4 years. Satisfied. Only Samrat is not satisfying any of the basic condition. So he is a non-resident. Am I clear? Am I clear? Friends, case scenario. We are going to read it twice, thrice before taking up questions. Okay. Mr. Zuccaro, a Singapore citizen, visits India for business purposes on a regular basis. He was in India in the past 4 years, 270, 190, 145, 155. In the current financial year, he, along with his family, had come to India on 10th August for a pleasure trip. His family returned on 31st August. He stayed back to complete some business commitment and returned on 17th November. So, in the past 4 years, 270, that year he satisfies basic condition 1 itself. 190, 190, he also satisfies. In 2 years, he has satisfies the basic condition 145 and 155. In the current year, 10th August to 17th November. 10th August to 17th November. How many years? How many days? Huh?
100 days.
100 days. He is not an Indian citizen or a person of Indian origin. He is a, so satisfies the second basic condition. Okay. Seems to satisfy additional condition. Can we add up 270 plus 190 plus 145 plus 155? 760. So he is a ROR. He satisfies the
So this, they have told that they have come for a trip. That period also we should include. So
yeah, that's what I'm saying. 10th August they came and he left on 17th November.
focus.
Okay. So he seems to be a ROR. Right. Mr. Zuccaro owns a manufacturing unit in Singapore. He basically comes to India for procurement of raw material. He appointed Manish as an agent who procures raw material from India and exports it to Singapore to his manufacturing unit and sells them as finished product there. An income of 875 is received in Singapore. Friends, for a non-resident, this is not taxable. For a resident, this is taxable. For a non-resident, here Zuccaro is a resident. He purchased a residential property for 1750 He sold this for 26.25. He paid brokerage of 2%. Mr. Zakaro also purchased the agricultural land in India and leased out. The tenant shares agricultural income as a consideration. For the previous year, it comes to 6,50,000. Based on the facts above, what is the residential status of Zakaro? ROR. Okay. His stay exceeds 60. Since he is a resident in the past 2 years and he is there for 7 years, it's for 760, he is a ROR. Question number 2. Assume for the purpose of answering this question only, Mr. Zakaro is a non-resident. Would income of 8,75,000 earned from procuring and export of product be taxable in India? No. No. Mere purchase and export will not amount to Indian income. Does not mean income is accruing in India. That's the point I missed there. I will write it also. Would income arise from transfer of residential property in income is chargeable to tax in India? Yes. Okay. If yes, compute the capital gains, please. 26.25 minus 2% minus purchase price of 1750. How much? 8 lakh. Yes, LTCG, since income is deemed to accrue or rise and taxable in the hands of non-resident. Yes, LTCG of 822,500 since he is a resident. This is C, sorry. Yes, LTCG is taxable, no indexation. So B, second is the answer. Second is the answer. Would income earned from agricultural land given on lease is taxable in the hands of Zakaro? No. Agricultural income is exempt. Okay. Okay. Agricultural income is exempt. Okay. Friends, no. Agricultural income is exempt. And I am not teaching you the tax liability now. Okay. After completing agricultural income also as a chapter, I will come back and work out how to compute the tax liability. Okay. Though in the examination, this is also a question, I will come back and work out this. Am I clear? Let us take the breakfast break now. We will come back and do the comprehensive question. Let's try to come back in 20 to 25 minutes. 9:45 or 9:50, we will start. Meet you soon. We will start back with some. Now, your pen and pencil, please. Your pen and pencil, please. Pen and notebook, please. Mr. Subha, an Indian citizen, is currently in employment. Is currently in employment with an overseas company located in country X during the previous year. So he is an Indian citizen. Okay. During the previous year, he comes to India for 135 days, not satisfying basic condition 1. Basic condition 2, he might satisfy if its income exceeds 15 lakhs Indian income. He is in India for 100, 50, 76 and 45 days in the past 4 years. His annual income for the previous year is income from salary earned and received in country X. income earned and received from a house property in country X, income deemed to accrue or arise in India, income from retail business accrued and received outside India but controlled from India, income accrue or rise from India, determine the residential status. He is not liable to pay tax in country X. He is not liable to pay tax in country X. Read through the question, we will work out. Read through the question. We'll start. Solution. Point number 1. Mr. Subhash is an Indian citizen. Point number 2. Stay in India during 25-26. Stay in India during financial year 25-26. Stay in India during financial year 25-26 hyphen 135 days. 135 days. He is not satisfying the first basic condition. And second basic condition is not applicable. Normally, he is a non-resident. Normally, he is a non-resident. Normally, he is a non-resident. Full stop. Next paragraph. However, one other condition to be checked. However, one other condition to be checked is his Indian income. One other condition to be checked is his Indian income. Under that, computation of Indian income. Income deemed to accrue or arise in India. Income deemed to accrue or arise in India, 2 lakhs. Income from business outside India but controlled from India. Income from business outside India but controlled from India, 10 lakhs. Income accruing or arising from India, 4 lakhs. Total 16 lakhs. Indian income exceeds 15 lakhs. Since since he is an Indian citizen, not paying tax anywhere outside India, since he is an Indian citizen, not paying tax anywhere outside India, he becomes a deemed resident. Provisions of RNOR is applicable. Provisions of RNOR is applicable. Friends, his Indian income exceeds, he is an Indian citizen exceeding and not liable to tax, he would be deemed to be a resident and will be RNOR. So recently also this is what is questioned. That special provision, please remember, that can be the questionable area, but one question surely from RS plus STI. Okay. Shall I? Mr. Duru, Indian citizen, central government officer serving in the Ministry of Corporate Affairs, left India on 31/3/2025 due to transfer of High Commissioner Office of UK. He did not visit India, so he is a non-resident. But for a non-resident, normally salary is taxable at the place where services are rendered. One exception is that ambassadors and high commissioners working in an ambassador or high commissioner office, the salary paid by Indian government will be taxable. Only salary not perquisite and allowance. He received salary received computed, which means a standard deduction is already provided. Foreign allowance, is it taxable? No. Interest on savings deposit with SBI, taxable. Suppose if it is optional tax regime, TTA. For those who don't know, I will teach it separately. For those who can recollect, savings bank account, you can claim 80 TTA to the extent of 10,000, and if he is a senior citizen, to the extent of 50,000 to ETP. If you don't remember, don't worry, I will teach you. STCG on sale of Indian shares. Dividend from an Indian company. Rent from property in London, deposited in a bank in London. Okay, is gonna compute the total income under optional tax regime. So you should provide the standard deduction, 80 TTE. Computation of total income. Hyphen non-resident. Salary. Hyphen taxable. As he is an Indian citizen, working in High Commissioner's Office of India. Outer column 20 lakhs. outer column 20 lakhs. Foreign allowance hyphen exempt. Let's go headwise. House property, rent accruing and received outside India, rent accruing and received outside India, not taxable because he's a non-resident, friends. It is not taxable. Dash. Capital gains. STCG on sale of shares of Indian company. STCG on sale of shares of Indian company, 2 lakhs. Other sources. Interest on savings account, 1 lakh. Dividend from Indian company, 50,000. Gross total income, 23 lakh 50,000. Am I right? 23 lakh 50,000. 80 TTA optional regime. Interest on savings account, 10,000. 10,000. Okay, I did a mistake. I'll correct it. I gave 75,000, which is also wrong. I did not read it properly, the question. I just started working. So this is wrong. So your answer will go by 75,000 from whatever answer I have given you. Okay, somewhere around 2350. Yeah. 2340. Okay, this is wrong. Please, 2340. Shall I? Mrs. Reshma, an Indian citizen, government employee working for the Indian government, submits the following. Salary income received in Malaysia for services rendered there. Profit from business carried on in Orissa. Profits from business carried on in Paris. Income is earned and received in Sydney, and business is also controlled outside India. Loss from business carried on in Canada, though profits are not received, business is controlled from India, so this can be adjusted against our Indian business income. Unabsorbed depreciation can be adjusted. Profit from Indonesia business managed from India, 60% is received in Indonesia and 40% in India. Determine the gross total income ignoring 115 BACA, assuming she is a RNOR or NR. Go ahead. Not ROR, only RNOR and NR, please. Only RNOR and NR. Do you have the answers? I'm having this as the answer. Salary 2 lakhs minus standard deduction, profit, loss from business carried on in Canada, and unabsorbed depreciation, profit from business in Indonesia. For a RNOR, it is fully taxable. For a NR, whatever is received in India is only taxable. Repeating, Reshma is a non-resident. She does not satisfy the basic condition. Normally, salary is taxable where Indian citizen is employed in Indian embassy or High Commissioner's office. The salary payable by the Indian government is taxable. So, here it is 2 lakh minus, they have said normal tax rate, that is the optional tax regime. Profit from the business. Profit from business in India, taxable. This is not taxable. Loss can be set off. Unabsorbed depreciation can be set off both for RNOR, not for NR. NR, this is not acceptable. Here, RNOR fully taxable, NR 40% taxable.
So for unabsorbed depreciation, the business is in Canada, right?
Yeah.
Then what?
So, unabsorbed depreciation of business in Canada. Loss from business carried on in Canada. The profits are not received, but business is controlled from India. So that's why we are allowing that loss and the unabsorbed depreciation.
Okay.
Can I? This is the 3 days, 4 days before examination question. Mr. Shankar, aged 44 years, is an Indian citizen. He graduated from UAE and employed in UAE. He never visited India from 2016, which means 10 years he never visited India. He resigned the job in 2025, completed all formalities, and came back to India. So from 11/12/25, he is in India, joining an Indian company. Gross salary received outside India, 36 lakhs. His salary is not taxable in UAE, and UAE does not tax individual for their income. His gross salary from Shakin Pro, the Indian company, is 850. He sold listed shares in October 25 as follows. X Limited, date of acquisition, cost of acquisition, sale price. Y Limited, STT was paid. He won an online game, 70,000. Determine his RS and compute his total income, assuming he did not opt out of default tax regime. My dear friends, if you don't understand my computation, as of now, take down that computation, but in capital gains, I will explain. this particular aspect of computation I will explain in capital gains chapter. As of now, I know if you are not understanding, you are blindly taking up. Okay, I am starting with computation of capital gains. After that, I'm going to write a theory and then go for answer. Computation of capital gains. Under that, I'm writing the theory. This is what I'm saying. If you don't understand, don't worry. When I'm dealing with capital gains, again, I will teach you this. If listed shares are purchased before 31/1/18, if listed shares are purchased before 31/1/2018, then cost of acquisition will be actual cost or FMV as on 31/1/18, whichever is higher. Whichever is higher. Once more repeating the theory. If listed shares are purchased before 31/1/2018, then cost of acquisition will be actual cost or FMV as on 31/1/18, whichever is higher. Next paragraph. If listed shares are purchased after 31/1/18, if listed shares are purchased after 31/1/18, then actual cost. Now, particulars X limited, Y limited. Particulars X limited, Y limited. Sale value, my dear friends, 300 into 3,200 for X limited, 300 into 3,200 and 250 into 3,300. For Y limited, 250 into 3,300. Less COA, cost of acquisition. Less cost of acquisition. Now, please remember, this is purchased before 31/1/18. So, I can take 1,800, whichever is higher. Whereas for this, I will take 2,300. So, for the first one, 300 into 1,800. For the second one, 250 into 2,300. I'm getting 4,20,000 and 2,50,000. I'm getting a capital gain of 4 lakh. This is my cost of acquisition. 300 into 1,800, 540, and 250 into 2,300, 575. So I am getting a capital gain of 4,20,000 and 2,50,000.
Excuse me, sir.
Raja, yes, Raja.
Sir, நம்ம வந்து lower of FMV or sale value தானே சார் cost of acquisition கூட compare பண்ணணும்.
இல்ல Raja, cost of acquisition will be actual cost or FMV, whichever is higher. However, that should not exceed, that is fair market value should not exceed sale price. அது வந்து அந்த ஒரு 2-3 வருஷத்துக்கு தான் எக்ஸீட் ஆகும். இப்ப 8 years ஆயிட்டு, அதனால அதை பத்தி கவலைப்படாதீங்க. காஸ்ட் ஆஃப் அக்விசிஷன் or FMV, whichever is higher மாத்திரம் வச்சுங்க. அந்த ஒரு 2-3 இயர்ஸ்க்கு தான் அது. இப்ப 8 இயர்ஸ் ஆயிடுது அந்த ரூல் வந்து. சோ இப்போ கண்டிப்பா இது மாத்திரம் பார்த்தா போதும் ராஜா.
Okay, sir. Thank you, sir.
Can I, friends? Okay. Now let us start. Residential status. Stay in India. Stay in India from 11th December to 31st March. From 11th December to 31st March. How many days? 21 plus 31 plus 28 plus 31. 111. 111 days. 111 days. December 21, because up to 10th only you should exclude. December, Jan, Feb, March. 111 days. Does not satisfy any of the basic conditions. Does not satisfy any of the basic condition. Hence, he is a non-resident. However, since he is not taxable in UAE, we need to check the Indian income we need to check Indian income to understand deemed resident. Okay. Computation of Indian income. This is where the question is brilliant. Computation of Indian income. Gross salary, inner column 8,50,000. Gross salary from India, my dear friends, 8,50,000. Standard deduction, I think he is under the new scheme only. Okay, assuming he did not opt out. Standard deduction 75,000, inner column within bracket. So the outer column is 7,75,000. The outer column is 7,75,000. Capital gains, you know both put together how much it comes to. How much? 420? 7,70,000. 6,70,000. 6,70,000. Winnings 70,000. So total income. $15,15,000. 15,15,000. Hence, he is a deemed resident, but the provisions of RNOR will only be applied. Anyhow, 15 only is taxable. Don't think that 36 lakhs is going to be taxable. Never. Only that you should declare that income in India. That's all. That is anyhow not taxable. That 36 lakh which he earned outside India will, provisions of RNOR will only be applicable. Okay. That's why he said this becomes popular nowadays. 7-mark question in our recent question paper. Am I clear? Any doubts, friends? Any doubts? Okay. It is sufficient to do this in residential status. What we will do is, before the end of the classes in 3 months, we will get RTP of September examination, mock test papers of September examination. In that also, whatever question comes, we will work out and see. Please don't go and do quantity oriented question. Read the concept again and again. Understand the concept so that you work lesser questions, save time, okay, than to do multiple questions. We have done 4 questions along with MCQ. We will have done 8 questions. We will do again some more questions when the RTP is released. There will be 1 question. 2 MTPs will come. So another 3 more questions, not more than that. Be sure, not more than that. Am I clear? Okay. Right. And then now we go to the next chapter, which is also a sure short question every time, not to be missed question, because in final we don't have salaries as a chapter. So obviously salaries is a questionable area. Before going into the chapter, I want to teach you 2 things which are very recent notification by the CBDT. Very recent notification. September is the time to question that, in my opinion. Okay. What is that? There was a concept called specified employee. There is a concept called specified employee. Till last year, specified employee means director of a company, and if the annual salary exceeds some 50,000 rupees. So the concept was not at all. Obviously, why will somebody up to 250, tax itself is not there. So nobody was giving importance. Now the definition gets a small change. What is specified employee? Director, substantial interest holder holding 20% or more of voting right. And the definition changed because employee whose salary does not exceed 4 lakhs. Salary means everything. Basic pay plus all monetary plus all allowances minus deductions. Why is this essential? These are only taxable in the hands of specified employees. Watchman, sweeper, gardener, gas, water, electricity, free or concessional tickets, usage of motor car, educational facility. Gas, water, electricity, gas, water, electricity, normally fully taxable. But if your salary does not exceed 4 lakhs, you are a specified, you are not a specified employee. This is not taxable for you. Watchman, sweeper, gardener, free or concessional tickets, usage of motor car, educational. Still 4 lakhs is a very, very small quantum. But somewhere we will use it and see. Somewhere I will explain you how this helps. But the best amendment notification came on this medical facility. We all know treatment outside India is not taxable. Please understand, treatment outside India is not taxable. It is not a perquisite. it is not taxable. Is the travel cost taxable? Is the travel cost taxable for employee and one attendant? Repeating. Treatment anyhow not taxable. Don't even worry about it. The question is whether travel cost is taxable. Normally, if it is exempt, if the gross total income does not exceed 2 lakhs, and that has been revised. Any medical expenses incurred by the employer on treatment provided, GTI does not exceed 8 lakhs. GTI does not exceed 8 lakhs instead of 2 lakhs. And gross total income, not salary, gross total income does not exceed 8 lakhs. About this, I will teach you in 80 CCD. Okay, so remember, this is not taxable.
Excuse me, sir.
Yes, Kanan.
Sir, in the meaning of the specified employees, sir, in third point, the employees whose salary does not exceed 4 lakhs there, sir. Sir, then we have to consider whose salary is below the limit of 4 lakhs only we have to consider,
No,
sir.
sorry. Employees whose salary exceed 4 lakhs.
Okay.
Sorry.
Thank you, sir.
So, treatment is not taxable. But only this travel cost you need to see 8 lakhs whether it exceeds or not. So, this remember, when we do questions, I will explain you more clearly about this. Otherwise, what should I do in salaries? Yes. Foregoing of salary is also taxable. If somebody says, I don't want this month's salary, it is not that it will not be included in gross salary. Once it was questioned, the employee gave back the salary to the company for a welfare scheme. Taxable. Foregoing of salary is taxable. Place of accrual, we are now clear about place of accrual. Okay. When I go into little slowly on various aspects of salary. Basic salary, we know there are two methods: fixed basic pay and grade system of basic pay. What is grade system? 15,000, 1,000, 18,000, 2,000. This means an employee joins in the pay of basic pay of 15,000. Every year he will get an increment of 1,000. So next year 16,000 per month. Next year 17,000. Subsequent year 17,000 till he reaches 18,000. Once he reaches 18,000, the increment will be 2,000. 20, 22, like that it will go. Grade system of basic salary means where increments are predetermined. You know the increment in advance. What is the increment you are going to get? You know in advance. That is known as grade system of basic pay. Okay, so this is a system. So suppose in a question, the employee has joined on 1/1/2025 in the pay scale of 40,000, 4,000, 52,000, 5,000, and they ask you to compute the basic pay of 25-26. They ask us to compute the basic pay of 25-26. What happens is, from 1/4/25 to 31/12/25, his basic pay will be 40,000 per month, and from 1/1/26 to 31/3/26, his basic pay will be 44,000 into 3. Okay, are you understanding this? Please remember, when they give a date, in that date only the increment will be applicable in the next year. On 1/1/25, he joined for 40,000 with a promise 4,000 will be his increment. So when we are doing for the financial year 25-26, that is from April to March, we should look into what was his salary in April to December, because on 1/1/26 he would have achieved this 4,000 increment. So for the last 3 months, it will be 4,000 into, 44,000 into 3. Are you understanding? Grade system of basic pay. Grade system of basic pay, where increments are predetermined, and increment is on the same day in which he has joined the employment. On the same day in which he has joined the employment, often this is tested. Often this is tested. Even in the recent examinations or RTP, I saw this being tested. Are you clear? Are you clear? Bonus, fully taxable. Commission, fully taxable. Incentives, fully taxable. All these things fall under the general category. All these things fall under the general category. In this case, we have to be little careful on bonus. Bonus, 20% of total salary. No problem. Take the total into 20%. Bonus, paid in October. Last month salary of October. So you will get only 40,000 as bonus. In our examination tension, we will take the March month amount. No. During October, he was only earning 40,000. Increment was only from January. Increment was only from January. So we have to be terribly careful in computing the bonus amount. We have to be terribly careful in computing the bonus amount, that it should be on the month in which it is declared, on that month or the preceding month, whatever. If they say annually, then becomes simpler. Okay. Allowances. Some allowances are fully taxable. Dearness allowance, city compensatory allowance, medical allowance is fully taxable. Repeating, medical allowance is fully taxable. Perquisite only will enjoy some exemption. Medical allowance is fully taxable. Transport allowance is fully taxable. For a physically challenged employee, there will be an exemption of 3,200. But transport allowance is fully taxable. Entertainment allowance is fully taxable. Later, if he is a government employee and not following the default tax regime, then we will give some exemption, deduction. But entertainment allowance is fully taxable. Any personal allowances are fully taxable. Any personal allowances are fully taxable. All these things are fully taxable allowances. Are you clear? Are you clear? Don't worry about fully exempt. There is no question on that. What is partly taxable allowances? House rent allowance, section 10, subsection 13A. Section 10, subsection 13A, HRA is a partly taxable allowance which will get some exemption. What is the exempt amount? Actual HRA received. If the company pays some HRA, what it is? Rent paid by me minus 10% of salary. What is salary? Basic pay plus DA forming part plus commission as a fixed percentage of turnover. If they say commission, don't take. If they say commission as a percentage of profit, don't take. Commission as a percentage of 50% of salary if the accommodation is in Delhi, Mumbai, Kolkata, Chennai. So if you are going to go and tell someone 50% of salary if the accommodation is in Delhi, Mumbai, Kolkata, Chennai, they will say you are wrong. They will say, no, you are not updated. It is now Bangalore, the Ahmedabad, Hyderabad are included. You have to answer them back. No, it is for financial year 26-27 under the new law. I am only writing financial year 25-26. In the next year, 3 metro cities are added. In the next year, okay, as soon as the budget came, one of my friend texted me saying, after 25 years, finance minister has listened to you, because the children education allowance from 100 rupees per month per child goes to 3000 rupees, because every time he used to say it is insulting to claim that 1200 rupees. Okay, so having said this, we are going to say after all these things, this cannot be claimed under default tax regime. So 75% of the population has already moved to default tax regime. Even if you are going to keep on increasing, it doesn't matter, but they have brought it. Now coming back. So there is a change in the cities, change in the rates. Please don't worry. Many people, oh, I read in a recent article, why are you not updated? No, that is in the next year. As of this year, as of your September examination, this is the definition. These 4 are the metros. Once more repeating. What is the HRA exemption? Actual HRA received. Rent paid minus 10% of salary. 50% of salary if the accommodation is in metro cities and 40 in the other cities. The term salary means basic pay plus DA forming part plus commission as a fixed percentage of turnover. Okay, we will first find out salary. We should first find out what is the salary, then go for these 3 rules, then go for these 3 rules. May I ask you to answer question MCQ 1? You yourself read and answer. On the screen is the MCQ. The question is, what is the exempt amount, not what is the taxable amount. அதான் அப்படிலாம் அடிச்சுட்டா வலிக்காது, அந்த சுகத்துல முட்டிக்கணும். கொஸ்டின் படி. What is the exempt amount?
For option B, 45,600.
Question B, 45,600. Is it not 48,880? No. 10,000 into 12, 1,20,000. 3,600 into 12. Yeah, 60% forms part.
இல்ல அது 10,000ல 60% 6,000.
DA is 6,000, 60% forms part. Please read the question. Please read the question properly. DA, take only 60%. Correct. எக்ஸெல்லாம் வச்சு போட்டேன், நான் தான் தப்புன்னு நினைச்சேன். I'll share the solution tomorrow with you because I need to make some small changes in the solution. I'll share the solution sheets also tomorrow. That doesn't mean you should be lethargic. You should work all the questions. You should work all the questions. Friends, 10,000. DA is 3,600 and the commission is 12 lakhs into 1%, 12,000. So 120 plus 3,600 into 12, somewhere 42,200. What is DA? 3,600 into 12? 43,200. So 120 plus 43,200 plus 12,000 will be my salary. Then if I go for the condition, condition 2 will be 5,500 into 12 minus 10% of that amount. You will get 48,480 as the minimum. Okay. Educational allowance 100 per month per child for maximum of 2 children. Okay. Hostel 300 per month. Traveling, conveyance, uniform, whatever officially spent is exempt. Education and hostel, I don't think there will be a question this time. Next time probably the rates have changed. Traveling, conveyance, uniform, whatever is officially spent. Suppose uniform allowance 1,000 is given per month, 750 is spent for official purpose, 250 into 12 becomes taxable. 750 is exempt, 250 becomes taxable. Now transport allowance 3,200 is exempt for physically disabled employees. Normally transport allowance is fully taxable. But for employees who are suffering from a physical disability, there is an exemption of 3,200 per month, and this is irrespective of actual spent. This is irrespective of actual spent. And one beauty there is, this can be claimed even under concessional tax regime. I've written at the end what can be claimed also. Now, remember, only HRA, CA, hostel cannot be claimed under concessional. You can still claim this official allowances and you can still claim transport allowance. Transport allowance. Is the class clear? Transport allowance can only be claimed by a physically challenged person, and that person, even if he is opting under concessional tax regime, he can claim that. He can claim that 3,200. So that is the benefit we are giving him. Whereas he cannot claim 80U and all. In 80U, there is an exemption deduction available that cannot be claimed. This alone, the law allows him, or the finance ministry has allowed him to claim. May I? May I? Okay. Let me talk about perquisites. And also a special point in perquisite, which I want to stress up. Perquisite number 1. Perquisites or benefit. So I only need to compute the value. So the taxable value, that is. Employer provides accommodation facility without charging any rent. It means rent free. Or charging a nominal rent. Okay, which means concessional rent. It is a perquisite. The perquisite value will be where it is owned by the employer, 5%, 7.5%, 10%, depending upon the population. Up to 15, 15 to 40, more than 40. Up to 15, 5% of salary. This is a perquisite. So salary is up to allowance, everything. Salary means up to allowance, everything. What are all they? Basic, bonus, incentive, commission, all the fully taxable allowance and all the partly taxable allowance to the extent they are taxable. Repeating, though I have written it later, I will come to that. Perquisite value here 5%, 7.5%, 10% of salary. What is salary? Up to perquisite, whatever is there. So all that basic pay, bonus, commission, so all monetary things, all allowances. And allowances sometimes are a part of the allowances exempt. So whatever is, so children education or anything. Only small benefit they give is here also DA forming part. You need not take the full DA if there is a forming part. Where employer takes the accommodation and lease and provides 10% or actual rent, whichever is less. 10% or actual rent, whichever is less. Cost of furnishing. Friends, perquisite value of furnishing will be 10% plus actual rent. Not only here. Here, suppose I give you a motor car and use it for exclusively personal purpose. Except laptop and desktop, all assets which are used by you. Wherever assets of employer is used by employee, 10% of the cost. Repeating, wherever assets of employer is used by the employee. Furniture owned by employer is used by employee, 10%. Projectors, LED equipments of employer used by employee, 10% of the cost. Motor car of employer used by employee exclusively for personal purpose, 10% of the cost. Wherever an asset owned by the employer is used by the employee, except laptop and desktop computers, 10%. So here also 10%. Basic pay plus DA forming part plus all other things. Friends, in the recent examination, they tested hotel accommodation for 15 days nil. After that only 24% of salary. After that only 24% of salary. Okay. Friends, May 26 examination. Okay. First adjustment. On 2/9/25, he was transferred to Jamshedpur, where he was provided with a room in a prominent hotel as a resident for his stay from 2/9/25 to 12/9/25. The rent is 4,500 per day. Is it a taxable perquisite? No. Because for 15 days, nil. For 15 days, it is nil. Okay. Recent examination question. For 15 days, it is nil. So it will not be taxable. Where due to shifting of employment, for first 90 days, only one house will be considered. From the 91st date, both will be considered. Please read it along with the special point. Once more, very slowly, I am taking up RFA. Rent-free accommodation or concessional rental accommodation is a perquisite where employer owns the accommodation. I own the accommodation. I give it to my employee. 5%, 7.5%, or 10% of salary, depending upon the population of that area. Depending upon the population of that area, 5%, 7.5%, 10%. You are clear? You are clear? Okay. Are you all understanding? Okay. Where I myself take it on rent and provides it to my employee. It is not owned by me. I myself take it on rent and give it to my employee. Actual rent paid by me or 10% of salary, whichever is less. Whichever is less. 5%, 7.5%, 10% of salary. Actual rent or 10% of salary, whichever. Apana salary. What is that salary? Before this, whatever comes is salary. Basic pay, bonus, commission, incentive, CCA, entertainment allowance, transport allowance for a non-employee, non-physical, normal employee. All other allowances, to the extent they are taxable, DA forming part. Okay, sir. I furnish the accommodation, 10% of cost of furnishing. Sir, I took it on rent and gave it as a furniture at the actual rent. I recovered a small amount from my employee, concessional rental accommodation. I will compute and take this. Is the class clear? Government employees, they themselves will give you. It's a simple calculation. Hotel accommodation, 15 days nil, more than that 24% salary. Sir, I am in Chennai. My employer transferred me to Bangalore. There also he gives me an accommodation. Law understands it will take some time for you to relocate your house there, to your family there. So for first 90 days, only one will be treated as, only one house will be treated as perquisite value. After 3 months, if you are keeping both the houses, both will be taken as perquisite value. Am I clear to you? Any doubts, friends? Okay. One special point, the whole class, please listen. My salary for 24-25, 25-26. My salary is 30 lakhs, 36 lakhs. An employer owned accommodation is provided to me. Perquisite value of RFA will be 3 lakhs, 10%, population more than 40 lakhs. So 3 lakhs, 3,60,000. Are you understanding? Are you understanding? Only one bigger benefit is given. The law says, suppose indexed value is lesser than indexed value will be perquisite value. What is that? 3 lakhs. In the financial year 24-25, the indexation value is 363. Currently, the indexation value is 376. In the exam, they will give you this. You need not remember indexed values. So it comes to 3 lakhs divided by 363 into 376. This will be treated as PV. This will be treated as perquisite value. My dear friends, however, perquisite value should not exceed the indexed value computed in the last year. Okay, in the last year it was 3 lakhs. In the exam question, they will clearly indicate this. Okay, in the exam question, they will clearly indicate this. For example, in this question, they said, okay, her employer gave him a rent-free accommodation. The house was taken on lease. The perquisite value of the last year is 55,000. Index values are 363, 376. Like that, they will give you. What you have to do is current year's perquisite value, indexed perquisite value of last year. If this is lesser, take this as the perquisite value. If this is lesser, take this as a perquisite value. I will work out 2 or 3 questions in this format and show you. Okay, they will give you the indexed value. They will give you the last year perquisite. Find out the indexed value of perquisite. If that is lesser, take it. If that is lesser, take it. Am I clear to you? Am I clear to you? Okay, quickly take up this example as a special point. Special point for RFA. I'll give you the theory also. Special point for RFA value. Okay. Step 1. Compute the current year's perquisite value. Step 1. Compute the current year's perquisite value based on salary of the current year. Step 2. Compute indexed perquisite value. Indexed perquisite value. Compute indexed perquisite value, which will be PV of last year divided by index value of last year, PV of last year divided by index value of last year into index value of current year. If step 2 is lesser than step 1, take PV as step 2. If step 2 is lesser than step 1, take PV of step 2. For example, write this. I will work out a couple of questions and show you also. Please remember this. This support, you know what is the furniture valuation and the 3 special cases. Am I clear to you? This is about rent-free. Suppose if I am collecting something from the employee, do this first and then say minus amount recovered. Nowhere before you should reduce the amount recovered. Final step only, amount recovered. Any monetary obligation of the employee, an expenditure which the employee should have incurred, but it is paid by employer, everything will be taxable. The actual amount except telephone, mobile and internet, because we don't know what is the official part of it, never our personal part of it. So watchman, sweeper, gardener, cook, water, gas, electricity, life insurance premium, club bills, credit card bills, any person, household expenses of employee met by employer, painting expenses of employees' residence met by employer, any personal expenses of employee met by employer will be regarded as a perquisite. Actual amount spent will be considered except telephone bill, mobile bill and internet bills. Interest-free and concessional interest loans. Had the employer not given you, you would have approached the bank. Bank could have charged you at a higher rate. Suppose bank charges 10%. Employer gives it for 6%. So you get a 4% concession on the loan amount. On that, it is taxable. Friends, there is something which I want you all to understand, that SPI rate prevailing on 1/4/25 for all of you. It is, as suppose if they give 3 or 4 rates, please take it at the beginning. They give only one rate. Suppose in an examination, to confuse you, they give 1/4/25 and 1/4/26. You take 1/4. For us, the previous year is 25/26. Had I taken the loan on that April 25, what would have been the interest payable? So I will take 1/4/25 rate. And small loans and loans for medical treatment are not permissible. Usage of movable asset, always 10%. Always 10%. Whereas for laptop and desktops, today every company gives employees laptop. Almost every company gives employees laptop at home or a desktop computer. For that, because that's given basically for official purposes only. So for that, nil. For that, nil. Is the class following? Okay. Now, the next perquisite requires a small amount of concentration and understanding. Almost in every examination, this is asked. Employer owned asset transferred to employee. Now, to a little extent, since you started understanding tax, there is a difference between given to employee and transferred to employee. Capital gain chapter, the word transfer means no more I am the owner. In income tax law, we don't use sale. Everywhere we use the term transfer, because sale is a very confined term. There should be a consideration. But transfer is a very elaborate term. Even if there is no consideration, I will call it as transfer. Now coming to this. Employer transfers asset to employee. Employer transfers asset to employee. How to value this perquisite? Employer would have purchased the long back. Today's value needs to be understood. Today's value needs to be understood. So the law has given us some guidelines. What asset is that? Is it something like an electronic equipment or computers, laptops, whatever it is? Is it motor car? Is it other asset? Original purchase price minus depreciation, 50%, 20%, 10%. Method, okay, diminishing balance, straight line method. From the date of purchase, okay, depreciation from date of purchase to transfer for completed years. Okay, depreciation will only be for completed years from the date of purchase to the date of transfer. Find out the value minus what you get from the employee. So 5 years back, I have purchased the computer, or 3 years back, I have purchased the computer for 2 lakhs. First year, 1 lakh. Second year, 50,000. Third year, 25,000. Now the value of computer is 25,000. I sold to my employee. I gave it to my employee for 10,000. Employee's perquisite is 15,000. Employee's perquisite is 15,000. Motor car, very popular. Companies give after 5 years that car to the employee. Okay. So because the maintenance cost will start after 5 years, let the employee bear it. Okay. So they give the car to the employee. All other assets like furniture, motorcycle, two-wheelers, all these things, 10% SLM for every completed year from the date of purchase. Not for an in-between period. No proportionate depreciation under income tax law ever. Ever. Even in PGBP, I'll tell this. So, this is the method of computing, repeating the whole concept. Computers and original cost minus depreciation from the date of purchase, diminishing balance. Motor car, 20%. Any other asset, 10%. Any amount recovered will be reduced. Any amount recovered will be reduced. Are you clear? Okay. This is a very popular question. This is a very popular question. Almost all salaries chapter, all salaries question has one adjustment, either motor car or electronic equipment. ESOP, employee given stock option. The company shares are given to the employee at a lesser price. Compare between the fair market value on the date of exercising the option minus actual price. Gift up to 5,000 is exempt. After 5,000, whatever is the excess taxable, but there is an alternative school of thought which says full value of gift is taxable. Repeating, I give my employee a 14,000 worth of mobile. There are two schools of thought. One school says 9,000 taxable. Another school says entire 40. Once it exceeds 5,000, the whole amount is taxable, because in other sources gift we are going to see once it exceeds 50,000, whole amount taxable. Like that they are saying for this also. Like that they are saying for this also. We should give both the answers. We should give both the answers. Are you clear? Are you clear? And the most important, gift on the occasion of wedding of employee is fully exempt. What is the wording? Gift on the occasion of wedding of employee. Employee's sister. No, only 5,000. Employee's daughter. No, only 5,000. Employee's brother. No, only 5,000. Employee. Even if the gift is 1 lakh, it is fully exempt. It is fully exempt. Remember, the law has used a very cautious word. Gift on the occasion of wedding of the employee is wholly exempt. Okay? Okay? Lunch. ₹50 per working day is exempt. So if 300 working days are there, into 50, 15,000 exempt, balance taxable, and that exemption cannot be claimed under concessional tax regime, default tax regime. You cannot claim that exemption. Leave, travel concession, something important. Again, it cannot be claimed under concessional tax regime. Again, recent examination, the question came. Fully exempt for employee and family members. Family members is restricted to 2 children. Family members is restricted to 2 children with a small benefit. If in the second birth it is twins, then it can go up to 3 children. Once more repeat. Normally this is exempt only for 2 children. But if in the second delivery it results in twin, it can go up to 3 children. Recent examination they asked. Okay. He went on a holiday with his 3 children, 1 major son and 2 twin minor daughter. So all 3 children can enjoy that exemption. All 3 children can enjoy that exemption. However, if it is concessional tax regime, you need not see children, etc. It is taxable. Am I clear to you? Educational facility. Friends, next year the rates have undergone a change. This year, exempt up to 1,000 per month per child. Whereas if it exceeds 1,000, it becomes wholly taxable. Child 1, the employer paid 900 per month, exempt. Child 2, 1,100 per month, fully taxable. 1,100 into 12, the entire amount becomes taxable. Please remember, educational facility has a small catch point. Okay, 1,000 per month exempt. More than 1,000 fully taxable. More than 1,000 fully taxable. In this May attempt question, you can see. Okay, the company also maintains and runs a school in Jharkhand, and they say the annual fee of other students in the same college is 2 lakhs. So it becomes taxable. It becomes taxable. Exceeds the threshold, so it becomes taxable. Is the class clear? Is the class clear? Okay. Medical perquisite. Medical perquisite. Normally fully taxable. You need not even worry. It is fully taxable, except government hospital, hospital owned by employer, specified disease, treatment outside India due to lack of medical facility, traveling cost of one patient and one attendant. Now this is if your gross total income should not exceed 8 lakhs. If it exceeds 8 lakhs, traveling cost will become taxable. Treatment is still exempt. This benefit now is restricted to 8 lakhs. Your gross total income should not exceed. If your gross total income exceeds 8 lakhs, you take care of travel. Let employer takes care of treatment. If your gross total income does not exceed 8 lakhs, even the traveling cost, if the employer is bearing, it will be exempt. Repeating, medical facility, how far it is taxable? Government hospital, fully exempt. Sundaram Medical Foundation, a TVS employee getting treatment in Sundaram Medical Foundation, nothing is taxable. Hospital owned by employer. You need not remember what are all the specified disease. Those specified disease fully exempt. Treatment outside India also exempt. Traveling cost alone, there is a small, okay, in these cases. The last perquisite is motor car facility. The last perquisite is motor car. There can be 3 cases, 3 usages. 3 cases, 3 usages. Repeating. Car owned by employer, expenses incurred by employer. Case 1. Employee uses the car officially. The employee does not get any benefit. Any benefit. Employee uses the car personally. Everything is a benefit. Everything is a benefit. Whatever I incur plus 10% of cost of car. I already told you, if I give a car, 10%. If I transfer a car, different. Okay. So friends, owned by employer, expenses incurred by employer, fully personal. Expenses on car, expenses on driver, plus 10% of cost of car. 10% of cost of car. Partly employee uses it both for official and personal purpose. 1,800 or 2,400. How do I determine? Small cars up to 1,600 cubic capacity, 1,800 per month. Indigo, Mahindra vehicles like that, large cars. Okay, more than 1,600 cc, 2,400. For driver, 900 per month. For driver, 900 per month. Are you clear? Car owned by employer. Employee himself takes care of the expenses. 600 or 900. 600 or 900. Whereas car owned by the employer incurs actual expenses minus 1,800, actual expenses minus 2,400. Whatever is the perquisite in part 1 becomes a deduction in part 3. What was perquisite in part 1? 1,800 or 2,400 depending upon the cubic capacity. That becomes a deduction. Actual expenses minus 1,800 or 2,400. For driver, 900. Okay, for driver, 900. A quick read through of perquisites, please. Quick read through of perquisites. Sir, should I read all the perquisites? Yes. Only 5 perquisites require more than 5 minutes. The remaining 7 perquisites totally require 5 minutes. Monetary obligation of employee met by employer, SBI rate minus lunch, ESOP, gift, all will not take time. But RFA, transfer, motor car, these requires, each one require 5 minutes. You should keep reading, you should keep comprehending. I will make sure that you remember all the 12 perquisites in the classroom itself so that you will not find it. But don't think these are difficult. Practice makes it perfectly to sit in your mind, at least till the exam date. After that, we can forget. That's the logic also. That's what is required also. If you go and talk to a previous year student itself, they will not be able to answer because they remembered it till examination date. Apart from this, in today's class, I am going to cover 2 more things. One is Provident Fund. One is Provident Fund. Okay, this is always the question is RPF only. Okay, always the question is RPF only, don't worry. RPF. Employee contribution, you will get 80C. Nothing else you need to do. But majority of the time, when we read a question, we always get confused. Basic salary, 80,000 per month. Employee and employer contributed 15% to RPF. Sir, employee contributed 15%. What should I do? I will say claim 80C. No, sir, should I not tax it as salary, later claim 80C? No, friends. This means the employer will not give you 80,000 to your house. He will deduct 12,000 and pay only a salary of 68,000. But what you will tax is 80,000. So employee's contribution is always part of this basic salary. You don't worry about it. Only later 80C chapter 6A, if you remember, those who don't remember, don't worry. When I teach 80C, I will talk about it again. You will get 80C. Employer contribution only you should worry. Never worry about employees' contribution. Employer contribution up to 12% of salary exempt. Employer contribution up to 12% exempt. And interest up to 9.5% exempt. Interest up to 9.5% exempt. Remember, my dear friends, exempt up to 12% of salary, exempt up to 9.5%, exempt lump sum, provided employee completes. Don't panic, don't worry. Just I am telling you, the TDS is under 192A. Later, when you remember, TDS should not be studied as a separate chapter. TDS is that section we can complete. That section we will complete. So if employee is not completing 5 years, whatever is the balance of that TDS tax has to be deducted. As of now, I'm not going into that. I'm just telling you, in the future, we are going to study like this. But as of now, it is not taxable. This alone is important. The others are just URPF. Employees' contribution is already taxed, 80,000 into 12. Whatever is the remaining balance, you should tax it. Okay. So suppose I get 80,000 into 12, 9,60,000. I get 15 lakhs. The remaining 5,40,000 will be taxable because it consists of employer's contribution, interest. Okay. There is something known as pension fund. Be it employee or employer, add it to gross salary. Employee, you need not add it. Employer, add it to gross salary. I will talk about deduction later. As of now, you should add it to the gross salary, the employer contribution also. Am I clear to you? Am I clear to you? Okay. We will complete just the MCQ part so that I'll give you some small knowledge. You can try the 2 questions. Otherwise, in the subsequent Sunday, not next Sunday, in the subsequent Sunday, I'll answer. We will just complete the MCQ part alone. Some MCQs you will get super knowledge. That's why I'm saying. I am looking into MCQ2 in page 10. You need not look into anything. You can just rely on the screen. Mr. Rajesh Sharma, an Indian citizen working as assistant manager, gets a basic salary of 58,000 per month. He used to travel frequently out of India for office work. He left India on 5th October and came back only on 2nd April. So he's not leaving for employment. He's leaving for business trip. Employment means permanently he will go there. Remember, for the previous year, the following information are relevant. DA, bonus, medical allowance. Is it taxable?
Yes.
Yes. Reimbursement of medical bill, taxable. Unless the 5 cases, it is taxable. He was transferred a laptop by the company. The laptop was purchased in October for 1 lakh. Company charge depreciation. I don't require that. I know what is the rate. House servant salary 4,000. Professional tax paid by employer. It's a perquisite. Monetary obligation of employee paid by employer. 400 equity shares were given at the rate of 250 when the fair market value was 350. STCG on which STT is paid 94,000. Mr. Rajesh has exercised the option of shifting out of default tax regime based on facts. What is the residential status of Rajesh? Start writing in your small hands. Okay. Period of stay in India. 1st April to 5th October. So 30 plus 31 plus 30 plus 31, 31 plus 30 plus 5. More than 180 days. 188. 188 days. ROR. So, point 1. The other information is not available. Last year he was here only. Those informations are not available. Resident, but can't determine whether resident ordinary or not ordinary because other information is not given. What is this taxable perquisite value? Friends, slow up. Okay. Bonus perquisite illa. Medical allowance is not a medical bill 15,000. Medical bill 15,000. Transfer of laptop. Transfer of laptop. Okay. Friends, listening only first. October 22, 1 lakh. October 23, 50,000. October 24, 25,000. October 25, 12,500. Is this correct? Up to October 25. Okay. But they transferred it for 15,000. PV is nil. A 12,500 laptop, if it is transferred for 10,000, PV is, if it is transferred for 15,000. So please write and keep somewhere why laptop is nil. One lakh, that becomes 50,000 next year. That becomes 25,000 next year. That becomes 12,500. So nil down. So now also I am only taking 15,000. House servant 48,000. House servant 48,000. 4,000 into 12, 48,000. Professional tax 2,400. This will be 400 into 100, 40,000. Okay. So 15,000 plus 48,000 plus 2,400 plus 40,000. 1,05,400. 1,05,400. What is the income chargeable as salary in, okay, let us compute. Okay, basic pay 58,000 into 12. How much? 6,96,000. DA 10%, 69,600. Bonus 98,000. Bonus 98,000. Perquisite நமக்கே தெரியும். Perquisite you last time you worked out. 1,05,400. Perquisite 1,05,400. Standard deduction 50,000 within bracket. Oh, sorry, medical allowance. Medical allowance 60,000. Medical allowance 60,000. Standard deduction 50,000. 50, opting out of 50,000. Professional tax 2,400. Professional tax will be added and reduced. Professional tax 2,400. How much it comes to? Correct? 976,600. Okay. What is the tax liability? Friends, remember the last point. There is an STCG of 94,000 for that 20%. So for 976,600, 476,600 into 20% plus 12,500 plus 94,000 into 20%, the all plus 4% HEC. 9,76,600, 476,600 into 20% plus 12,500 and 94,000 into 20%. STCG on which STT is paid. All add it up, add 4% HEC. What's the answer? Okay. Okay. All of us. Okay. Now, interesting question. What would be the tax liability if he does not exercise the option of shifting out of default tax regime and pays tax as per default tax regime and pays tax as per default tax regime? Okay. Okay. அங்க அப்படி போற்ற முடியாது. அங்கதான் நான் உங்கள்ட்ட திருப்பி வரேன். Standard deduction will be 75,000. Professional tax cannot be claimed. Okay, so salary will be, question number 5. Salary will be 976,600 plus 50,000 plus 2,400 minus 75,000. So 976,600 plus 50,000 and 2,400 minus 75,000. How much it comes?
54,000.
9,54,000. Are we getting it? Since this is less than 12 lakhs, write down. Since this is less than, since it is an MCQ, I'm not fully working. Since this is less than 12 lakhs, no tax for salary. No tax for salary. So only for STCG. For that you cannot claim rebate. For that you cannot claim rebate. 94,000 into 20% plus HEC. $19,550. Am I clear? Am I clear? Okay, we stop here. Try out the next 2-3 questions. If you are not getting answer, don't even worry. I'm there to support you. Okay. When we meet next class, we will do some more intricate provisions of salary because I'm yet to touch terminal benefit. I want to touch it once, the terminal benefit, and then in the next class, positively I will complete HP and capital gains. So that one exclusive Sunday we will sit for PGBP. Okay, that day, even if it is little longer, we will complete PGBP. Okay, meet you in the next class. Thank you very much. Okay, don't worry, I'll take care. All the best, friends.
Thank you, sir.
Thank you, Raja.
Thank you, sir.